Yes, people. So welcome back after that sumptuous lunch break. So we'll get started with the next big ticket topic, that is consolidated financial statements. Okay. So consolidated financial statements basically has four Ind AS: Ind AS 27, 28, 110, and 111. So if this particular topic we're done means four standards, damar. Okay. All right. So let's look at the Ind AS 21, Ind AS 27 first. Ind AS 27 talks about separate financial statements, not consolidated financial statements. It talks about separate financial statements, meaning if you have any investment in subsidiary, associate, or subsidiary, associate, or joint venture, how that investment will be valued in separate financial statements. That is what it is giving the guidance on. So these investments will be either valued at cost model. Like if you purchased it at investment for 10 lakh rupees, you can show it at 10 lakh rupees itself. That is one option. All right. Or you can go for Ind AS 109. And what does Ind AS 109 says? For equity shares and all, you can't go for ACM method. Default category is FVTPL method, but there is also an irrevocable option of FVT OCA method. So one of the two you can choose. So this is as per the Ind AS 27 ka guidance. However, if the investment is held for sale, then you have to compulsorily apply Ind AS 105 ka provision itself. Okay, that is one. However, if it's an investment entity, so what is an investment entity? Investment entity are those entities which raises the funds. They raise the money from the public to provide investment management services. And after raising the money, what will they do? They'll invest to get some return in the form of interest or dividend or capital appreciation. And they value their investment on a fair value basis. This is what is the definition of an investment entity. If you are an investment entity, compulsorily you have to value your investment at FVTPL method itself. Okay. For normal entities, this is the option. If you are an investment entity, you have to compulsorily go for FVTPL option only. No other options is allowed. Okay. So suppose an entity was an investment entity in 1 year. Next year it became non-investment entity. So if there is a shift in category, then what to do, sir? Investment entity means it is currently following FVTPL method. Even other than non-investment entity can also follow FVTPL method itself. Meaning whatever is being followed, same thing you can continue because that is also permissible. Or if they want non-investment entity, can go for cost model also, right? So far they're following FVTPL method, but even cost is allowed for them. So you can also go for cost model. Whatever is the fair value on the date of reclassification, on the day this particular change happened. On that change day, find out what was the fair value of the investment. That fair value itself becomes deemed cost for application of cost model. Okay, so that is this. What if it's other way around? Meaning a non-investment entity became an investment entity. Non-investment entity means obviously they would have been following FVTPL, FVTOCA, or cost model. Anything is permissible for them. But however, if it is an investment entity, you have to compulsorily follow FVTPL only. So that means going forward, you have to follow FVTPL method itself. Okay. So that any difference between the fair value and the current carrying amount of investment will be transferred off to SPL. However, if you are valuing an investment under FVTOCA method, any OCA balance will be released off to SPL account. So this is your summary of Ind AS 27. So that's all that you need to remember for Ind AS 27 ka perspective. Then we will dive into consolidation. And first we will talk about subsidiary ka consolidation. Okay. Subsidiary ka consolidation is given in Ind AS 110. Okay. All right. Sir, subsidiary ka consolidation happens only if the control is existing. Only one company controls the other company, then only consolidated financial statements ka preparation becomes necessary. Otherwise, it is not necessary. And when can you say you have control? Control ka definition, you will have to look at, I think Ind AS 103 also gives this definition, or control ka definition, I think is given in Ind AS 110 itself. Excuse me. Okay, control means you can say you have a control when you have power over investing and you have exposure to variable rate of return. And you have the ability to use the power to affect the returns. And this power over investee, you say you have it provided you have the right to direct the relevant activities. If parent can control the relevant activities, can all the relevant activities means major decisions of the subsidiary, if parent can control, then we say parent has a control over subsidiary company. Generally, we assume that if you have more than 50%, if one company owns more than 50% voting power in another company or equity shares of another company, you get control. Okay. But control can be established to other factors as well. All right, that is one. However, certain companies need not prepare consolidated financial statement. Consolidated financial statement means parent ka and subsidiary ka financial statements you are clubbing up. That clubbed statement only we call it as consolidated financial statement. So this consolidated financial statement, few companies need not present. One is intermediate unlisted holding company. What does this mean? Sir, let's say there is A Limited. A Limited has a subsidiary B Limited. B Limited has another subsidiary C Limited. A Limited owns 90% of B. B Limited, let's say, owns 100% of C. Like this. Okay. Now, here if you just check, the ultimate parent is A Limited. But we are not talking from A limited perspective. We are talking from B limited perspective. Okay. So B limited, no sir, need not prepare CFS. B limited need not prepare CFS provided certain conditions are satisfied. What is that condition? One, B limited ka shares in this example should not be listed, nor it should be in the process of listing. That is one. And the NCIs of B limited have been informed and they don't object to not preparing CFS. Like if you just check over here in B limited, there are two shareholders. A owns 90% of B limited. That means there is another person, outsiders who own 10%. That only we call it as non-controlling interest. So B limited has informed NCA that we are not preparing CFS and NCA don't object. They are fine with it. That is the second condition. Third one, any of the intermediate parent or immediate parent or ultimate parent is already preparing CFS. B limited need not prepare CFS provided A limited also prepares CFS in this case. So the ultimate parent is preparing CFS means B limited can take the consolidation exemption. That is one. Okay. Second one is investment entities. If you have investment entities, they are also exempted from preparing consolidated financial statements. Okay. Now, consolidated financial statements, how to prepare, I've given some rules. Based on this only, we solved many questions in our class, more than 100 to be precise. Yes. So let's do one thing. Okay. Let's apply. All these are pointers. All these are the things that we do in problem. I've written it as pointers because these are all totally practical chapter. This is okay. So let's do a thing. Let's solve one or two questions and then come back to maybe these notes so that we can interpret this little better. Okay, that's how we'll take up consolidated financial statements revision little better maybe. Yes. So let's take up maybe first question number. I'll take one simple question to begin with. Then we'll take up one question which has a little more adjustments. This is a very straightforward question. Question number 88. Prepare consolidated balance sheet as on 31st March 2017 using the following data. H Limited and S Limited. H Limited has purchased 70% of S Limited on 1st April 2016. So the year beginning only H Limited has got the control. So they have given the simple balance sheet. Okay. So this is the opening balance of reserve and the current year ka reserve they have given. All right. NCA has to be valued on net asset basis. Okay. We know that NCA can be valued under consolidation under two bases. One is the fair value method and under PSNA basis. Proportionate share of net asset basis. Here we are valuing under proportionate share of net asset basis. Okay, very simple question, no treatment at all. Okay, or no adjustments at all. So first, the first working note that we prepare in consolidated financial statements is you don't have any fair value adjustments here, so you can directly start with net assets on the date of control. So because obviously, sir, if you are a shareholder, as an equity shareholder, your right is towards the net assets of another company. If you buy equity shares of another company, you have a right over their net assets, right? So first step is to find out the net assets on the date of control, because what you can really control is the net assets, right? So first step, net assets on the date of control. This net assets, or how do you get net assets? Basically, assets minus outside liabilities. All the assets you have minus non-current liability, current liability if you have, you deduct it. You'll get net assets. But the problem is we want net assets on the date of control, and the date of control here is 1st April 2016. Okay. Do you know the balance sheet on 1st April 2016? No. This is the balance sheet as on 31st March 2017. We need 1 year before data, which is not given in the problem. Hence, in these sort of consolidation problem, we will work out net assets using another approach, which is nothing but shareholders funds approach, or you simply work out using equity approach. In fact, in your CA Inter and all, you used to show on shareholders funds. What you used to show on the shareholders funds? Equity share capital and all the reserves in surplus. So you will take that equity shareholders funds is nothing but net assets. Okay. So we'll use that approach and work it out because that's easier, because all the assets and liability data is not available, but reserves and surplus data, share capital data will be available. That's the reason. So how do you find out? Net asset is nothing but equity share capital and all the reserves in surplus. What is the equity share capital? At the year end, it is 10,000. Normally, companies don't issue the shares and all, and no information is given that shares have been issued. So the year beginning also shares will be assumed, or share capital will be assumed to be 10,000 only. That is one. Okay. And then reserves. Reserves only on the date of control. When did you get control? 1st April 2016. So they have given opening balance of reserve, which is what? 3,000. This was already existing. So that reserve means was already existing. Reserve balance on 1st April will be 3,000. This current year ka reserve came after acquisition, so it was not available. So on the date of acquisition, only 3,000 was applicable. Okay, so reserve balance was only 3,000. So these two condition is nothing but what's 13,000. That itself becomes net assets on the date of control. Okay, this is the shareholders funds approach we use to get the net assets here. That's one. Second step is to find out the goodwill on the date of control. How do you find out goodwill? First, take the investments, amount paid. The cost of the investment. How much did the parent company pay to get to buy this investment, get the control? 10,000. That is one. Okay. But this investment is only for 70% because we didn't get 100% control in subsidiary company, but only 70%. So the cost of the investment is 10,000. Then what do you do? Other 30% is owned by NCA. So add NCA. NCA, they told it should be valued on net asset basis. So proportionate share of net assets. Do you know net assets already? Yes, on the date of control, net asset was 13,000. Of this, 30% belongs to NCA. So 13,000 ka 30% becomes your NCA, which is 3,900. So this is 70%, this is 30%. Adding those two, it became 100%. Deduct net assets on the date of control. We already found out. Net assets on the date of control is 13,000. This is 100% of net assets. Deduct this, obviously you will get what? The goodwill on the date of control. Goodwill on the date of control is 900. If this goodwill is impaired, means deduct impairment loss and you will get the goodwill on the date of reporting. The date of reporting as in at the end of the year. Here there is no impairment loss data. So goodwill on DOC date and the DOR date or date of reporting or at the end of the year also it will be same. This is the next working note. Okay. Third working note we generally prepare for analysis of profits of subsidiary company or analysis of post-acquisition profit of subsidiary company. Here there is nothing to analyze. Since the parent company acquired the shares on 1st April, right? This 3,000 profit was already existing, which we call it as pre-acquisition profit. Pre-acquisition profit means those reserves in surplus existing before holding company got control. So this was already existing. So this is pre-acquisition profit. This 3,000 current year profit came after the holding company got control. So this is post-acquisition profit. So we prepare working note number 3 for analyzing it. There is no adjustment here. So post-acquisition profit will be split between parent and NCI in the respective shareholding ratio, which is 70 and 30%. That's what we do in that working note. So 2000 into 70% will be 400, 2000 ka 30% will be 600. Okay. So if you want, you can prepare this working note or here directly skip. Okay. Next working note will be preparing non-controlling interest. We want even non-controlling interest will come in the consolidated balance sheet. So hence we want NCI at the end of the year. But we already know NCI on the date of control. We already got this. How much is the NCI on the date of control as in the previous working note, which is 3,900. So take that, right? And after acquisition, subsidiary made some post-acquisition profit. How much post-acquisition profit subsidiary made? Subsidiary made a post-acquisition profit of here only we wrote 2,000. Entire 2,000 is not the subsidiary ka share, right? So I mean NCI ka share. NCI share is only 30%. So 2,000 ka 30% is 600. Why do we add post-acquisition profit? Is whenever a company makes profit, their net asset balance will increase. Okay. If they make loss, net asset balance will reduce. That's the reason if they make any post-acquisition profit, if subsidiary makes post-acquisition profit, subsidiary ka net asset will increase. If subsidiary ka net asset will increase means parent ka share and NCI ka share also will increase. That's the reason we add post-acquisition profit, 2,000 ka 30%, which is 600. Okay. There is no other adjustment. So NCI on the date of reporting at the end of the year becomes these two addition, which is 4,500. Okay. Then we need consolidated reserves in surplus to be shown in the balance sheet. First of all, what is holding company ka or parent company ka reserves in surplus? Adding these two, it is 15,000. Okay. Then holding company also subsidiary made post-acquisition profit of 2,000. No? Of that, holding company has 70% share. So that you show it under retained the retained earnings over here. So 2,000 ka 70%, which is 1,400. So this 15,000, if you add that post-acquisition profit of subsidiary, you're going to get 16,400. This is the consolidated reserves that you show in your consolidated balance sheet. Okay, that's all. Hardly any adjustment here. And how do you prepare consolidated balance sheet? Simple. Parent assets you take, subsidiary assets you take, and 100% line by line you go on adding. PP ka 50, no adjustment. So 15 plus 12 is 27,000. Okay, investment in subsidiary will not come because for holding company it is an investment, which is an asset. But for subsidiary company it is their share capital. A component cannot be shown both as a capital as well as an asset, so it will get knocked off. But instead of this investment, goodwill or bargain purchase gain will come. Here, what did we get? Goodwill. So you'll have to show goodwill as a non-current asset over here. Okay. And anything else is there? Next, the only thing is the current assets. Line by line, you add. There is no adjustment. 5,000 plus 3,000, which is 8,000. Total assets you got. Okay. Then share capital. The subsidiary ka share capital and reserves in surplus will not come because parent cannot control. What parent can control is really only the net assets. Hence, net assets we add 100%. Even though parent owns only 70% equity shares in subsidiary company, with 70% they can control 100% of net assets of subsidiary company. That's the reason all the assets and liability we add 100%. Share capital and all you cannot control, hence it is irrelevant. A subsidiary ka share capital will not come. Only holding ka share capital will come under share capital side. And reserves in surplus or other equity, we have already done a working note. The consolidated reserves is 16,400, which will come here. All right. So you are showing in consolidated financial statement, we are showing 100% of assets and liabilities. But if suppose subsidiary company shuts down, assume it will not. If subsidiary company suppose shut down, will parent get entire 100% of net assets of subsidiary company? No, they will only get 70% because they own only 70%. So balance 30% who owns? NCI. Hence, NCI also should be shown in the consolidated balance sheet as a separate category, which we have already worked out. NCI ka balance is 4,500. That will come in your consolidated balance sheet. Okay, this is the thing. So you should not forget this. Goodwill, bargain purchase gain, and NCI. Okay, so this should not be forgotten. Rest all of the assets and liability go on adding. So that no other assets and current liability is given. So that means balance sheet total matched up. This is a simple question with hardly any adjustment. Just to get started, we took up this particular problem. Okay. All right. So let's do a thing. Let's take up one more question, which is more exam related. Okay. With some adjustments. So you know this background. To just build up a background, I took a simple question. Let's take one more question with some adjustment. These sort of questions you can expect in examination. Okay. And then once this is through, then we will go back to our pointers and try to revise the things in words. That way we'll be able to connect to the things better. Ram Limited acquired 60% ordinary shares of Krishna Limited. So with 60%, obviously you will get control, and they acquired the shares on 1st October 20x1. So this is your date of control. On 31st March 20x2. So summary is balance sheet of two companies they've given. So balance sheet they've given. Okay, fair enough. Then retained earnings of Krishna Limited, that is a subsidiary company, showed a credit balance of 60,000 on 1st April. So 1st April, they have given here balance as on 31st March 20x2. So 1st April ka balance is nothing but opening balance. Retained earnings ko opening balance is given. So opening balance was there before parent got the control, right? Because you got the control only on 1st October. So this was already existing. So that means this is pre-acquisition profit. So out of this pre-acquisition profit, dividend of 10% was paid in 1st November. So they used pre-acquisition profit and they paid dividend. So any dividend paid out of pre-acquisition profit only, we term it as pre-acquisition dividend. Any profit declared out of pre-acquisition profit, we call it as pre-acquisition dividend. Okay. We have to do some adjustment for it, which I'll tell you. Ram has credited the dividend received to its retained earnings account. Okay, they have received the dividend, so they've treated it as an income and transferred to P&L. Retained earnings is nothing but profit retained in the business. The fair value of plant and machinery on 1st October 20x1 was 4 lakh rupees. On the date of control, fair value of machinery is 4 lakh. The rate of depreciation of machinery is 10%. Okay. Following are the increases, that directly given increases on comparison of fair value as per respective Ind AS with book value. So fair value when compared to book value has increased, they are saying. So this is the fair value. Not the fair value, they've given fair value increase amount with respect to few amounts. Land and building compared to book value, fair value is more by 2 lakh. Inventory compared to book value, fair value is more by 50,000. Similarly, trade payable compared to book value, fair value is more by 20,000. Okay, so these are the things. Assume all the reserves on 31st March 2000 was same as 1st April. So you have some other reserves also over here. They're saying closing balance and opening balance is same. That's what they're trying to say. Even if they don't still make the same assumption. Okay, so here there are some fair value adjustment, there is some dividend adjustment. That's pretty much it. So yeah, so let's go over this particular question. I've solved this question in the interest of time, because if I start solving now, it will take 40-45 minutes. I don't want to waste so much of your time. So we'll quickly run through what is this all about. Okay, so first is it. Now, actually, no, sir, whenever you get control, first time when you get control, no, you need to apply, or the day you get control, you need to apply Ind AS 103, that is business combination. Okay, that standard will get triggered. Okay, consolidation will come at year end. Okay, let's say at year beginning, let's assume year beginning you got control. In this case, it is not, you got it during the year. For a simplicity, let's say at year beginning you got control. That means at year beginning you will apply Ind AS 103, and at year end you need to prepare CFS. And for preparing CFS, you will apply Ind AS 110, Consolidated Financial Statement ka rule. Okay, so what Ind AS 103 says is, since you have got control over subsidiary company, all subsidiary ka net assets parent has to recognize, and Ind AS 103 says all the net assets should be recognized at fair value, not at book value. All subsidiary ka assets, currently subsidiary is showing at the assets in their balance sheet at book value. But Ind AS 103 says all the assets of subsidiary company, all net assets, not just assets, liabilities also. The net assets of subsidiary company has to be taken over and recorded at fair value, because the consideration that you pay, no, because to get control, parent would have paid the money, right? The money will be paid not based on book value, but be based on the market value, which is nothing but fair value. Hence, all the assets and liability also should be recorded at fair value, is what Ind AS 103 says. Okay, so that's the reason if there is any fair value adjustments, you should consider that, because how do you get goodwill? To get goodwill and all, how to calculate goodwill and all is accounted, or goodwill is accounted as per Ind AS 103 and not as per Ind AS not as per Ind AS 110. The initially whatever goodwill you get on the date of control, that accounting is as per Ind AS 103. Okay, so you have to consider all the fair value of net assets for goodwill calculation. That's the first step. So since here there are some fair value adjustments, we'll have to see. Okay, fair value adjustment means obviously you have to increase the value of assets. If you increase the value of assets, net asset will increase, right? That's the reason. That only we're calling it as fair value adjustments. So before you put up, normally we put up the working out number one as net assets on the date of control. But before you do that, fair value adjustments affect net assets, because fair value will increase the asset. Increase in value of the asset will obviously increase the net assets. So hence working note number 1, we'll put it for fair value adjustment over here. So first fair value adjustment is for all other assets directly they gave the fair value increase. Each asset, how much asset increase directly given. But for plant and machinery, they told like this. Fair value of plant and machinery on 1st October, that is on the date of control, is 4 lakh. So you need to compare fair value with book value and then say how much asset increased or decreased by. But the problem is the balance sheet is as on 31st March 20x2. So subsidiary company ka plant and machinery, how much is it? 2,70,000. Sir, this is the value as on 31st March 20x2. But the fair value what they have given is as on 1st October. This is the carrying amount as on this, but the fair value they have given in the question is 1st October 20x1. Okay, this carrying amount is 270, fair value is 4 lakh. You can't compare these two and say fair value is increased by 1,30,000. That is wrong because they are on a different dates. So you have to get them on the same date. First, we need to find out the carrying amount on the date of control. Okay, so you have to do a reverse calculation. How much is the depreciation on machinery? 10%. So 10% depreciation is already charged. That means the opening balance of plant and machinery was 3 lakh. Do you agree with me? Because the current year you have charged 10% depreciation. So opening balance is 3 lakhs. So 3 lakh at 10% if you apply, you will get 30,000 as depreciation. Hence the closing balance of plant and machinery has become 2,70,000. So you have to do the reverse calculation. After charging, or you can also present like this. So 2,70,000 is after charging depreciation. 10% is already deducted as depreciation. That means it represents 90%. We want opening balance which represents 100%. So how much is that? 2,70,000 into 100 divided by 90. If you do, obviously you will get 3 lakh. So that's the first calculation. I've done it over here. So opening balance, the carrying amount on 1st April 20x1 was 3 lakh. We have not done revaluation and all. Revaluation will be done on the date of control. Hence this I've left it blank. We want the carrying amount on the date of control. Control is 1st October. So 6 months asset has been used. So deduct depreciation for 6 months only. 3 lakh into 10% for 6 months. That will be how much? 15,000 rupees. So 3 lakh minus 15,000 will give you a carrying amount of 2,85,000. So carrying amount of that machinery in subsidiary books is 2,85,000. But the fair value of the asset on the same day is 4 lakh because this is the date of control. So fair value is 4 lakh. So compared to carrying amount, fair value is increased by how much? 1,15,000. 4 lakh minus 285, basically 1,15,000. Okay, sir. This is the fair value adjustment that we're talking about. Okay. But subsidiary company, have they considered 4 lakh in their books? No. They have this fair value adjustment and all is required for your Ind AS 103 and consolidation purpose. All these are consolidation adjustments or business combination adjustment. Subsidiary has not done that. For next 6 months, what have they done? They have charged usual depreciation. For the next 6 months, again 15,000 they've charged. Hence the carrying amount is 2,70,000 for them. Okay. But in reality, for consolidated financial statement, should you depreciate for the next 6 months for 15,000 rupees? No. If you are adopting fair value, that means the carrying amount of this particular asset for CFS purpose is not 285. You should consider 4 lakh. You have to increase from 285, you have to increase it by 115 and consider it as 4 lakh. So for the next 6 months, depreciation should be calculated on 4 lakh. So you will do 4 lakh into 10%. Why 10%? That is the depreciation rate for next 6 months, which will be 20,000. So for consolidation purpose, we should have taken depreciation of 20,000, but subsidiary has charged only 15,000. That means due to this adjustment, due to this fair value increase, some additional depreciation will arise. Here what's up? Subsidiary has charged only 15,000, but required amount of depreciation is 20,000. So additional depreciation due to fair value adjustment is 5,000, which subsidiary has not done. Not a mistake. They need not do it because all these are consolidation adjustment. But since now we are preparing CFS, we have to give effect to this also. The additional depreciation 5,000 also you need to consider. That's one. Okay. Then you'll get the carrying amount. That's all right. So this is the first thing. What is this the only asset that got where there is fair value adjustment, or there are others also? There are others also. First we'll write off plant and machinery. Plant and machinery ka fair value increase is how much? We already got it here, which is 1,15,000. On the other assets, fair value increase, they have only directly given. On building 2 lakh, inventory 30,000. We wrote this. And on trade payable, fair value increase is 20,000. Since liability has increased, I'm showing it as negative. So net fair value increase is how much? Net fair value increase of net asset is how much? 325. Okay. So obviously, since fair value has increased, net asset also will increase. So when you're calculating net assets, this 3,25,000 also should be added up. Okay. Because there's the increase in the value of the assets. Okay. That is one. Next now is your normal calculation net assets on the date of control. But on the date of control, we don't have balance sheet. Yes. Date of control is 1st October. We don't have that. Hence, net assets we always work out from the shareholders funds approach, where you consider equity share capital and we consider only pre-acquisition profit. Okay. So equity share capital, do you know? A subsidiary company, yes. Equity share capital of subsidiary company is 4 lakh. Though this is year-ended balance, we assume that share capital at year beginning and year ending was same. So share capital is 4 lakh. Then what's it? Other reserves. Other reserve, they said opening balance and closing balance is same. They said it in the notes. Yes, that means this 2 lakh was already existing when holding up before parent got the control. So this was already existing. So this is again pre-acquisition profit. Okay, sir. All right. What about fair value adjustment? That also you need to increase, which we have already considered over here. 1 second. Okay. So this is also done. These are done. Okay. Next is check if you here retained earnings. So they've given an adjustment of retained earnings. What did they say? Retained earnings of subsidiary company had an opening balance of 60,000. So 60,000 was already existing on 1st April and we got control only on 1st October. So the 64,000 opening balance was already existing, means this is pre-acquisition profit. That should also be considered, which we have considered. Okay. All right. So opening balance of retained earnings was 60,000. All right. Check the closing balance of retained earnings. How much is the closing balance of retained earnings? Somewhere they've given here. Closing balance of retained earnings. In the balance sheet, you show obviously closing balance. Closing balance has become 164. So 60 has become 164. That means it has increased. No. Hang on. Though the opening balance they told is 60, using this opening balance, people, you paid some dividend. Yes, that's what they said. Opening balance of 60,000 was there, out of which a dividend of 10% was declared. So 4 lakh is the share capital. You declare the dividend at the rate of 10%. So minus 4 lakh into 10% is 40,000. So using the 60,000, you paid 40,000 dividend. That means profit remaining is only 20. From 20, it became 164. That means current year, you made some profit. From 20,000, the profit, the closing balance has become 164. Profit has increased. How? Because current year subsidiary made some profit. So basically 164 minus 20,000, which is 1,44,000. This is current year ka profit, whole year ka profit. When did we acquire the control? We got the control on 1st October. That means April, May, June, July, August, September. For first 6 months, whatever profit is made, that is post or pre. First 6 months ka profit is already made before parent got control. So out of this 1,44,000, the first 6 months ka profit. First 6 months ka profit will be 144 into 6 by 12, half of it, which is 72,000. That is pre-acquisition profit. And the next 6 months ka profit, 70,000. That will be post-acquisition profit. Okay. And for net assets, how are we calculating? We're taking all the share capital and adding all the pre-acquisition profit. So this 72,000 also should be added, which I've presented over here. I directly calculated over here and showing it. If you want, you can present it like the way I've shown it here also. Okay. So if you add all this, you're going to get net assets on the date of control. Next step is what? Calculate goodwill or bargain purchase gain. So first you'll consider what? Cost of investment. How much investment, how much was the shares purchased for? Parent purchased the investment in subsidiary company by paying 8 lakh rupees. So the cost of the investment is 8 lakh. Okay. This was only for 60%. That means you need to consider NCI. NCI, they have not given anything. So if they don't give anything, obviously if fair value of NCI is given, we'll take it. Or if they've given some data to calculate fair value, we'll consider it. If they don't mention anything, we'll always calculate or assume that NCI is valued under PSNA basis. And using net assets, we'll calculate NCI. Do you already know net assets? Yeah, net asset is 10,57,000. Of that, 40% is NCI ka share, which will be 420 to 800. Then deduct net assets on the date of control, which is 1057. So you'll get the goodwill on the date of control. That's the value. Okay. There is no impairment loss. So the goodwill on the date of control and the goodwill on the date of reporting, meaning at the end of the year, goodwill values will be same because no impairment loss data given for goodwill. Okay. Next is what, sir? One working note I told is analysis of post-acquisition profit of subsidiary company. So if there are some adjustments, we'll put up this working note. In the last problem, there was no adjustment, but here there are. So what is the post-acquisition profit of subsidiary company? We already got it over here. Post-acquisition profit of subsidiary company is 72,000. So take this. Okay. All right. This is as per subsidiary ka books. But is there any consolidation adjustment? Yes. Sir, you did some fair value increase. Due to fair value increase, you will get some additional depreciation. What was our additional depreciation? We've already marked it over here. Just 5,000. This has subsidiary considered? No. Should we consider it for CFS perspective? Yes. So additional depreciation means when you charge depreciation, profit will be, they have not charged, but we have to charge now. We have to account this now. If you have to account this now, if you have to account one expense, P&L balance will be same or it will reduce. It will reduce. So reduce 5,000 from post-acquisition profit. So that means this became how much? 67,000. This post-acquisition profit of subsidiary company, obviously, if subsidiary makes post-acquisition profit means subsidiary ka net asset will increase. So that will also cause the holding ka, parent ka share and NCI share also to increase. Hence, the post-acquisition profit will be distributed to parent and NCI in 60-40 ratio. That is their respective share. Okay. All right. Next is a non-controlling interest, NCI. We already know NCI on the date of control. How much was that? We already calculated that to be 10,57,000 rupees. Where? Okay. Different. Oh no. Yeah, here. NCI on the date of control is 4,20,000 to 800 rupees. This we already considered. And post-acquisition profit share also of NCI share, we got it, which is 26,800. Add this. Okay, but there is one more. Sir, if you pay here, no sir, out of opening balance of 60,000, retained earnings for opening balance was 60,000. In using this, you paid some dividend. That dividend only we call it as pre-acquisition dividend. So how much dividend you paid? 40. That means opening balance of retained earnings is only 20. Now touch your heart and tell. Okay, when you calculated net assets, you took a pre-acquisition profit, you took opening balance of retained earnings. Should we have taken 60 here or should we have taken only 20? Because out of the 60,000, 40,000 is given as dividend. That means the retained earnings for opening balance we should have taken only as 20,000. But since this dividend got declared at a later date, on the day you got control, retained earnings for opening balance was 60, so we are forced to take 60. Yes, no. But in reality, this opening balance of retained earnings is not 60, it is only 20. Because out of 60, 40,000 is being paid off for a dividend. That means net asset has unnecessarily been increased, because using this only you're finding out net assets. Some extra 40,000 you have considered means net asset has increased. Yes. If net asset increases, means parent ka share and NCA ka share also has unnecessarily got increased. But since we can't adjust it over here, because on the date of control 60 was existing, dividend adjustment came later on. Hence, what do we do is in NCI working note, whenever there is pre-acquisition dividend, that pre-acquisition dividend you should reduce from NCI also and other equity wala working note also. Because we can't reduce it from here, we will reduce it from the next best angle. Obviously, net assets of subsidiary company increases NCI ka and parent ka share. So due to this dividend adjustment, their NCI and parent ka share have unnecessarily been increased. Hence, we need to reduce. So reduce it. What is the dividend declared? 40,000. Okay. 40,000 means obviously net asset will reduce, right? And NCI has only 40% share. So 40,000 ka 40% is how much? 16,000. So 16,000 will be the NCI ka share of net asset reduction, which will account directly in NCI. Like this. So if there is, or if you want it in one liner, if there is any pre-acquisition dividend, reduce that pre-acquisition dividend from NCI ka and parent ka other equity ka working note respectively for their respective share. Okay. Dividend declared by subsidiary is 40,000. NCA share of that is 40%. So reduce 40,000 to 40%, which is 16,000. And you'll get the NCA on the date of control, which is this much. Okay. Then lastly is other equity wala working note. It's not really a working note, it's a note number. We are preparing this in such a way that directly this number you can take it and show it in the balance sheet. Okay. You can present this in any format, but if you present in this format, straight away you can take this number and show it in balance sheet. Okay. In balance sheet, you would show other equity, and under other equity, all the reserves will come now. So I've called out all the reserves: retained earnings, capital reserve, other reserves, total. Okay. So check. So in consolidated balance sheet, what and all reserves will come? Subsidiary ka reserve will come? No, only parent ka. Parent has what and all reserves? They have other reserves. So I've taken other reserves opening balance to be 6 lakh. Okay, here. And what about retained earnings? Subsidiary ka retained earnings was 1,14,000. But out of this 1,14,400, how much is opening balance? How much is closing balance and all? They've not given. That breakup they've not given. Hence, I've assumed opening balance of retained earnings is 0. You can assume opening balance is 114,400 also. Okay. I've assumed that entire 1,14,000 is a total comprehensive income, meaning it is a profit made by a parent company in the current year. You can also assume that this number was there in the opening balance and assume current year profit to be 0. Your choice, because absence of information. Okay. So if there is any, in business combination, you may either get a goodwill or bargain purchase gain. If you get bargain purchase gain, that will be shown under capital reserves. I've called out in this problem, it is not there. And what? Post-acquisition profit of NCI you already gave. Post-acquisition profit of parent also you need to account. So what is post-acquisition profit of subsidiary company with parent's ka share, which is 40,200. That will increase your retained earnings, which we have called out over here. Not only that, there was some pre-acquisition dividend. Pre-acquisition dividend, you need to reduce it over here. NCI ka pre-acquisition dividend share already have accounted. Total dividend declared is 40,000. Of that 40% NCI share you already reduced. 60% is parent share. 40,000 ka 60% is 24,000, which you will reduce from retained earnings ka working note, and you will get the balance of all the reserves. Summing it up, you're going to get 7,30,600. This 7,30,000 will directly come in your consolidated balance sheet as other equity. If you want, I can just show it over here. This is your consolidated balance sheet. Other equity is 7,30,600. Straight away you can show. And consolidated balance sheet is pretty straightforward. If you want, maybe quickly run this working out, we can quickly run this by also. Just 1 minute. I'll get this a little closer. Okay. How do you prepare consolidated balance sheet? Line by line, you need to add this. That's all. This is 3 lakh plus 60,000. Okay. Plus what, sir? Is there any fair value adjustment? Yeah, there is a land and building of fair value adjustment, 2 lakh rupees. So there is no depreciation data, so ignore. So this will be what? 8,60,000. So land and building ka is 8,60,000. Okay, but you don't show in balance sheet each assets. You'll show PPA and you'll prepare a note for it. So let's do up this also. Plant and machinery. 4,80,000 plus 2,70,000. 480 plus 270. Is there any fair value adjustment? Yes, there was a fair value adjustment of plant and machinery. I think we already worked that out. Fair value adjustment of this one is 1,15,000, but there is also additional depreciation. So this will be 1,15,000 minus there is an additional depreciation of 5. So add this, adding all this, 480 plus 270 plus 115 minus 5. If you do, I'm getting 8,60,000. Is there any other PP? Not that I see. So I added these two. 860 plus 860 is 17,20,000. Check in the balance sheet. Have they shown 17,20,000? Yes. The breakup of this they will give it in notes to accounts. That's fine. Okay. Next asset is what, sir? Investment. Investment will not come. Rather than that, goodwill will come. How much goodwill we got? As per our working note, the goodwill was 1,65,800. They have shown up. Yes. Next is what, sir? Inventory. Inventory 240 plus 2,40,000. Plus 72,800. That gives you 3,12,800. Okay. Or I think there was some fair value adjustment for inventory also. Yes, there is a 30,000 fair value adjustment. So plus 30,000 if you do, you're going to get 340,800, including fair value adjustment. Okay. Then what, sir? Then it is financial asset receivable. Add this. Is there any fair value adjustment? 119,600 plus 119,600 plus, no, there is nothing, plus 80,000 will give you 199,600 considered. Okay, next is cash, 29,000 plus 16,000, which is 45,000 considered there. Okay, this is on this. And on the liability side, you'll write equity and liabilities. Under that equity, you'll show equity share capital and other equity. Equity share capital of only holding company will come, which is 10 lakhs. Other equity we have already worked out, we ticked off also. Do not forget the non-controlling interest to be shown. As per our working note, non-controlling interest we got is, where is that? 4,33,600. How much have they shown? 433,600. Then the current liability line by line you add. Only trade payable there is fair value adjustment. If you do this, balance sheet matched up. Okay. So balance sheet matching in the consolidated balance sheet is very, very straightforward activity. All assets and liability you add 100%. Assets and outside liabilities. Okay. Do not forget to show goodwill, bargain purchase gain. Do not forget to show your basically excuse me, non-controlling interest. Okay. There's one more which we will discuss. Okay. So I think now we have got a fair idea about how to prepare consolidated financial statements. Now let's come back to our notes and understand. There are a few more adjustments. We may not have time to cover all the problems with all the adjustments. So hence I've written the points. Now we have a basic idea about consolidated financial statements. Now remaining pointers, some 1 or 2 extra adjustments will come, which we will learn as a pointer itself. Okay. So first you need to prepare net assets on the date of control, which we already see. Okay. And how do you prepare net assets? They will not give you date of control ka balance sheet. Hence, we will use shareholders funds approach. So basically, you will take equity share capital and add all the reserves and surplus existing on the date of control. That only we call it as pre-acquisition profit. Add all of them. And NCA, there are 2 ways to value NCA. One is the fair value method. Another one is proportionate share of net asset basis. If you are valuing NCA under fair value method, the value that of goodwill that you get is full goodwill, meaning that goodwill belongs to both parent and NCA. So if there is any impairment loss on such goodwill, both parent and NCA, both of them will bear it. That impairment loss will be given both to the parent as well as NCA. However, if you are valuing NCA under PSNA basis, the value of the goodwill you're going to get is the partial goodwill or only parent share of goodwill, and only parent will bear the impairment loss on such goodwill. Logic and all approved it in the regular class, so I'll not go into too much of details there. Yes, so for now we'll just quickly run through what is required. Then there is fair value adjustments. We already know. If there is fair value adjustments, what should we do, sir? We have to obviously consider that fair value adjustments in net assets wala calculation. But due to this fair value adjustment, you also may get additional depreciation. And additional depreciation where you should consider in post or in analysis of profits wala working note. We prepared working note number 4, analysis of profit wala of subsidiary working note. There you need to consider. Basically, there you need to deduct. Okay, if there is a reversal of depreciation, you will add back. Because if you are charging additional depreciation, means profit will reduce. If there is reversal of depreciation, means you will add back. So when there can be a reversal, sir, instead of fair value adjustments could be either a fair value increase or it could be a fair value decrease. If fair value is decreased, means you don't have to charge additional depreciation, rather you have to reverse. Okay, so that also they may give, but in all our problems we have seen so far, it was always fair value increase. Hence we only got additional depreciation, but it could be other way around also. Hence that's the reason I've called it out. Okay, then if acquisition of subsidiary was made during the year, it was not made at the beginning of the year. If it is made during the year, then part of current year profit also will be pre-acquisition profit, which we saw in this problem. 6 months ka profit was pre, or 6 months of current year profit was pre, 6 months of current year profit was post, like that. So pre-acquisition profit means what? Profit of the subsidiary company made before the date of control. Okay, and this will be considered for net asset wala working. Post-acquisition profit means what? Profit made by the subsidiary after parent got the control. This post-acquisition profit will be considered in analysis profit of subsidiary ka working. Okay, and dividend out of pre-acquisition profit, we just now discussed. If there is any dividend paid out of pre-acquisition profit, then net assets have been unnecessarily increased. If net asset increases means parent ka share and minority ka share or NCI ka share would have been unnecessarily increased. Hence, from NCI working note, you need to reduce this, as well as from parent ka share. Parent ka share is shown in other equity as retained earnings. So you'll have to reduce this from retained earnings also. That is what I've called out here, which we applied in this particular product. Okay. Then there is another problem called closing stock. If there is any fair value adjustment on closing stock, in the previous problem, if you just check, there was a note. There was a closing stock fair value adjustment, but they told that closing stock is not sold. All of them are already there. But in the one of the problem you'll see in question number 94, blue Evans. This question is there in study material only. I've given a reference. So in 1 year, no sir, business combination, or one more point is before this point. Sir, in days 103, no, you'll apply it only once. On the day you get control, you apply in days 103. That's all. Okay, it's only one time application standard. The day you get control, apply in days 103. But consolidated financial statement is a recurring activity. If you have control for 5 years, for all the 5 years, you need to prepare consolidated financial statement. Year 1 also you need to prepare consolidated financial statement. Year 2 also, year 3 also, year 4 also, year 5 also. So consolidation is a routine activity. Is that okay? So here in this problem, sir, you would have got the control. I'm giving you just background. Only one adjustment is different. That's the reason not doing this, hence discussing. First year you would have got the control. So first year you need to prepare CFS. Second year also you still have control. So second year also you need to prepare CFS. In first year when you got control, no, there was some fair value adjustment in stock. So closing stock has been increased. The next year, no, such closing stock will be sold. Okay. So we already know this. 1 year ka closing stock is next year ka opening stock. If closing stock of previous year is increased due to fair value adjustment or revaluation adjustment, opening stock of next year also you need to increase. If opening stock increases, we already know this. If closing stock increases means profit will increase. Yes, closing stock increases means obviously we have already done this, right? So net asset increases, so profit increases, so we have done this. But however, if opening stock increases means, if you don't want to prove this equation, you can assume, prepare a simple trading account, assume some random numbers, opening stock purchases, sales and closing stock, calculate profit. Okay. Then increase opening stock. All other number you keep it constant. Only opening stock you increase, the profit will reduce. Sir, if opening stock increases, profit will reduce. So next year, if current year, if you have increased the closing stock, means next year opening stock also you need to increase, right? That will lead to reduction in profit. So that means this particular profit, no sir, in the next year when you're preparing, in year 2 when you're preparing consolidated financial statement, you need to reduce this from analysis of profits wala working. On the day you did fair value adjustment, you'll consider this a net asset wala calculation, okay? For the next year or the year in which you have sold this inventory, you'll have to reduce the same thing from analysis of profits wala working note. So the reference of this is question number 94. This is the only thing. Then this only the opening stock increase, you just have to reduce it. In year 2, you have to reduce that profit or revaluation adjustment on stock from analysis of profits wala, analysis of profits of subsidiary wala working. That's the only thing. Rest every adjustment is same. Okay. And post-acquisition profit or post-acquisition loss in OCI of subsidiary company is given to both parent and subsidiary company. Obviously, if there is post-acquisition profit means net asset will increase. If there is post-acquisition loss means net asset will reduce. Not only post-acquisition profit or loss, even subsidiary company, if it has any OCI items, that also will be distributed among parent and NCI. Okay. Since you're distributing loss also, NCI balance may become negative. Let's say NCI balance on the date of control. NCI balance on the date of control was, let's say, 1 lakh. But post-acquisition loss, so post-acquisition profit means you add because net asset will increase. If it is post-acquisition loss, you'll reduce. No, NCI share of post-acquisition loss, let's say, is 1,20,000 assumption. Okay, that means in this case, NCI balance has become negative. Okay, what India is 103 says is doesn't matter whether it is positive or negative, don't bother. If it is post-acquisition profit or loss or OCI item, simply distribute. If NCI becomes negative, don't change. Don't show NCI on the asset side now. On the liability side itself, you showed NCI as a negative number. Don't change the category. Okay. And let it come on the equity and liability side itself. Here you show, first you show equity and then below that equity share capital and other equity. Below that you show NCI. NCI you show now here how much have we got? 20,000. This 20,000 you show it as a negative number here. That's all the standard says. In fact, accounting standard has a different viewpoint over here. They said this should not happen, but forget about that. Accounting standard ka gali we have already left. CA inter ka level we have already passed. Now we are in now we are in CA final level. So that's the reason what India is 110 says is you simply do the allocation. NCI balance can become positive, NCI balance can become negative. Doesn't matter. If NCI balance is positive, means show it as positive number in your consolidated balance sheet. If it is negative, means show it as negative number. That's all. Okay, you don't have to worry about positive, negative here and all. Another adjustment which can come in consolidated balance sheet is unrealized profit or loss on inventory. What is this? Let's take an example and try to prove it. This also can be easily fitted into the consolidation questions. Okay. Sir, this unrealized profit on inventory calculation, no, sir, can come under two scenarios. When the parent has sold goods to subsidiary, or when subsidiary has sold goods to parent. Under any of the scenarios, it's fine. It could come. So let's take some numbers and try to understand what this point is about. So let's say parent has sold goods to subsidiary. The parent has purchased this goods for 80,000. So the cost of this goods for the parent is 80,000. But parent has sold this goods to subsidiary for 1 lakh, because these are two different companies. No? Any company, within the company is also many departments transaction at sell to each other at selling price. So here the transaction is happening across different companies. So parent is saying, no, we will sell it at selling price only. Just because you are our subsidiary, we will not sell it at low price. We will sell it at correct price only, is what the parent ka stand is. So parent purchased this for 80,000, but they have sold it for 1 lakh. So through this transaction, parent has made a profit of 20,000. Do you agree with me? Yes, because 80,000 worth of goods has been sold for 1 lakh. So profit made by the parent is 20,000 rupees. Now, sir, as long as parent is a separate legal entity, subsidiary is a separate legal entity. So in their books, they can do the respective accounting. That's all right. But for consolidated financial statement, we are not treating parent and subsidiary as two different companies. We are treating them as one group. We are treating them as one. Okay. So if you show this profit and all, then it looks like you have made a profit from yourself. Because for consolidated financial statements, there are no two companies. There is only one company. Okay. Hence, there is that we call it as unrealized profit. Some profit needs to be eliminated because it is unrealized. Okay. So entire profit you will eliminate, sir. No. Sir, here parent has sold goods to subsidiary. Check what has subsidiary done. Because after purchasing the goods, even subsidiary will sell it to their customers. Okay, it could have happened. Now here, let's assume 50% of the goods of such goods, no, after purchasing from parent, subsidiary has sold 50% of the goods. That means 50% of the goods is still remaining in their godown. Okay, subsidiary purchased the goods. After purchasing, 50% of such goods they have already sold. 50% of the goods is still remaining. Okay. Now, unrealized profit. The heading is unrealized profit on inventory. Now you think logically, sir. Okay. Now, cost of the goods is 80,000, but parent sold it for 1 lakh. That means a subsidiary company, let's say it's S Limited, they are showing, if they have some goods, means they will show it as inventory. Okay. Obviously, subsidiary company purchased this goods by paying 1 lakh. So they will show it at 1 lakh, but 1 lakh is for 100%. They have only 50% goods remaining. That means inventory is shown by subsidiary in their books at 50,000. And in consolidated financial statement, what do? Parent ka inventory you take, subsidiary ka inventory you take, add them up and show. All the assets and liabilities, you do the clubbing. But yes, now sir, subsidiary is showing this inventory at 50,000. But touch your heart and tell, is the cost of, because we know this, inventory should be valued at cost or NRV, whichever is lower. Is the cost of the inventory from the group perspective. The cost of the inventory from subsidiary perspective is 50,000. That is correct. Now we are not talking from subsidiary company or parent perspective. We are talking from group perspective. From the group perspective, is the cost of the goods really 50? No. The cost of the goods is not 50 because the total cost of the goods was 80,000. Total cost of the goods was 80,000 and that 50% is sold. That means only 50% is remaining. So the cost of the goods is really only 40. But subsidiary is showing it at 50. That means some profit element is included in the closing stock of a subsidiary company, which we call it as unrealized profit. Okay, unrealized profit, and this has to be eliminated. That's what we call out here. Okay, so if there is any unrealized profit on such goods, that we need to eliminate. Okay, this unrealized profit and all you cannot show, because if you show, it will look like you made profit from yourself, which would be foolish things to say. Okay, sir. That's so. Just to sum up, what is it again? So if parent has sold goods to subsidiary or subsidiary to parent, doesn't matter. I took the example of parent selling the goods to subsidiary. So sale would have happened at the selling price itself. So through this transaction, parent would have made some profit. The profit I have assumed is 20,000 over here. Okay. So after purchasing the goods from the parent, subsidiary has sold off 50% goods. So other 50% is only remaining. That means what, sir? So subsidiary is valuing their inventory at 50,000. They purchased for 1 lakh. So 1 lakh is their cost price. Only 50% is remaining. So they are showing their inventory at 50,000. But really from the group perspective, the cost of these goods is not 50. The cost of this goods is 80,000. 80,000 is for 100%. For 50%, how much? 40,000. So inventory should have been valid. If you want to show this inventory in consolidated financial statement, it should be shown only at 40. But currently it is shown at 50. Hence this 10,000 unrealized profit you need to eliminate. Okay. That's all. Basically, I'm saying unrealized profit should be eliminated not on the total goods sold. Unrealized profit should be eliminated only on the goods remaining as inventory. That's what I've written here. Now check the points. Find out the total profit made in this transaction. Find out how much portion of the goods is still lying as inventory. Only unrealized profit included. If all such goods are sold, then there is no unrealized profit. Unrealized profit means profit element included in closing stock. How much ever profit element is included in closing stock, that only that you need to eliminate. Eliminate unrealized profit on such goods lying as closing stock. Not the total profit, but only profit element included in the closing stock. Okay. So where you will eliminate, that depends on who made the sale. If parent has sold goods to subsidiary, so parent is the father, subsidiary is the son. So that means parent is selling the goods to subsidiary, means we call this as a downstream sale, because parent is at the top, subsidiary is at the bottom. So parent has sold means the arrow is going down. So hence we call it as a downstream sale. So if parent has sold means parent would have made the profit, right? So parent ka profit we show it in other equity, retained earnings. So this unrealized profit you have to reduce it from the other equity retained earnings while working. In other equity working note under retained earnings. That means this particular adjustment affects only the parent. It will not affect the NCA, because parent company made the profit. No, so this profit ka share NCA will not get. So if parent has sold goods to subsidiary means it will come in your other equity while working note under retained earnings. What if it's other way around? Subsidiary has sold the goods. If subsidiary is at the bottom, they have sold goods to parent. That means the arrow is going up. So that we call it an upstream sale. So if subsidiary has sold goods to parent means subsidiary has made some profit. So if subsidiary makes the profit means net asset of subsidiary will increase. And if net asset of subsidiary increases means both parent ka share will increase and NCA ka share will increase. But this is unrealized profit. Hence what you have to do? You have to eliminate that. If subsidiary has made the profit means reduce that unrealized profit from anyway before distributing subsidiary ka post acquisition profit you prepare working note. No? So reduce it from analysis of profits of subsidiary ka working note. Okay. Post acquisition profit straight away you don't distribute. If there is any unrealized profit, deduct that and then distribute the balance profit to parent and NCA. So it affects analysis of profit of subsidiary ka working note. So obviously if subsidiary ka profit is getting affected means parent ka share and NCA ka share both will be getting affected. So this is some adjustment I've brought in. That's fine. Without this also you can cover up these sort of problems. Okay. All right. The next one is, excuse me, unrealized profit on PPE sold. Sir, it's possible that not only goods has been sold, some goods could be sold by parent to subsidiary or subsidiary to parent, but sometimes even an asset like PPE or intangible assets can also be sold. So in that case, is there any unrealized profit? Yes. But one second, it's not pretty straightforward. Okay, let's take a small example. Then maybe we'll look at the wordings. It may be a little better to connect. Let's say parent got the control of subsidiary on 1st September. So all these are problem specific adjustments. We don't have time to cover all the problems, right? Because every adjustment will be same. Only this much will be different. So instead of doing whole problem and wasting so much time, right? I'm thinking I'll just discuss small adjustment and go on doing. This way we can revise the things, many things at a lesser time. So that's the intention. Okay. All this you will see in our problems. If you open our notes, all this you will see. That only I've just brought it as a small adjustment for explanation's sake. Okay. So parent has got the control on 1st September 2025 assumption. So one property, plant and equipment has been sold by the parent to subsidiary company on 1st October. 1 month after they got control, parent has sold some, not goods, a plant and machinery or a PPE has been sold for how much value? 15,000. But the carrying amount on the date of sale was, actually this should not be 1st August, it should be 1st October on the date of sale. Carrying amount was 10,000. So 10,000 worth of an asset, parent sold it for 15,000. So parent ended up making some profit. How much profit? 10,000 if they sell it for 15,000 means parent made a profit of 5,000. Correct? So that means this 5,000 is unrealized profit, sir. No. Hang on. You can't straight away eliminate that. Why, sir? Check this, sir. Okay. This particular data. So first, this also you need to present a working note. So cost to S purchased, So if parent has sold for 15,000 means subsidiary company has purchased this. So subsidiary company ka cost on 1st October. Transaction has happened on 1st October. So the cost for subsidiary company is 15,000. Correct? All right. So if subsidiary company has purchased PP means obviously they will depreciate it. So they purchased on 1st October and year ends on 31st March. That means they'll depreciate for 6 months. So 15,000 they'll depreciate for 6 months. What is the useful life remaining I've given? 5 years. So 15,000 residual value data not given. So 15,000 minus 0 divided by 5. That will be 3,000. That is 3,000 as a depreciation every year. Here depreciation will only be for 6 months, which will be 1,500. So the carrying amount of this asset in subsidiary ka books will be 13,500. Yes or no? Correct? But in reality, the cost from the group, you might have sold it for 15,000, but its real cost is 15 or only 10. Its real cost is only 10. So if you had taken 10,000 means what would have been the depreciation? Because carrying amount of that asset on the date of sale was not 15, it was only 10, right? So if parent had sold goods to sold this PP at 10,000 itself, what would have happened? Then how much would have been the depreciation? 10,000 you would have depreciated over 5 years. That is 2,000 is the depreciation per annum. For 6 months it would have been 1,000. So carrying amount would have been 9,000. Yes or no? Correct. So what I'm indirectly trying to say, sir, unrealized profit is not 5,000. Unrealized profit is only 4,500. So why, sir? Sir, though a parent made a profit of 5,000, right? Since subsidiary purchased it at higher cost, they are charging higher depreciation. Instead of charging 1,000 depreciation, they are charging 1,500. So 500 extra depreciation subsidiary is accounted. So 500 rupees unrealized profit indirectly has already got eliminated. So again, you can't eliminate 5,000 unrealized profit. You have to eliminate only 4,500. That is a funda over here. Because if it's an asset, means asset also will get depreciated. So if you sell it at higher price, depreciation charged by subsidiary also will be higher. That's the reason the difference between cost price and selling price, you can't treat it as, or carrying amount of selling price, you can't treat it as unrealized profit. How much of a depreciation is already charged extra? Consider that also and then find out unrealized profit. That's what I've told over here. So how to find out that? I've expressed in words. See if this makes sense to you. Find out the carrying amount of PP on the consolidated balance sheet side if the sale was not made at all. If the sale was not made, the carrying amount would have been only 9,000. Correct? No? Because parent would have charged depreciation only this much. Okay. Now find out the actual carrying amount after sale in this thing. So after considering the sale, the actual carrying amount at the end of the year is 13,500. If the sale was not made, carrying amount would have been 9,000. Okay. If the after sale, because of sale, the carrying amount has become 13,500. So the difference between these two is unrealized profit, which is 4,500. That's what I've called out over here. Okay. Sir, what should we do for unrealized profit here? That again, it's the same thing, sir. You need to check who sold. If parent has sold this machinery to S, means parent made the profit, and parent ka profit will come in other equity wala working note under retained earnings. Okay, so that means this adjustment affects only the parent. However, if subsidiary has sold this machinery to parent, could be possible. That means subsidiary made the profit. So subsidiary makes the profit, means their net asset is increased unnecessarily. So then it will affect your parent and NCA, right? So you have to reduce this from analysis of profits wala subsidiary wala working like that. Same as unrealized profit on inventory, that wala adjustment. Okay. Okay, so this is not required. Then if you have any intercompany transaction means debtor, creditor. If parent has sold goods to subsidiary, means if parent has not yet collected the money, so parent will show this as a debtor, and subsidiary has purchased the goods. That means they have to pay, so they will show it as a creditor. One company, same component, no? One company is showing it as a debtor, another company is showing it as a creditor. But so as long as there are two separate companies, one company can show it as a debtor, another company can show it as creditor. But when you're preparing consolidated financial statement, you are treating them as one. So if you show both this debtor and creditor, right? Because it's already shown in subsidiary and parent ka books. So if you show this in consolidated financial statement also, then it will look like you have to receive money from yourself, you have to pay yourself. Yeah, because you are not treating consolidated financial statements as two separate companies, as one companies. Hence all this intercompany transaction like debtor, creditor, bill receivable, bills payable, loan given, loan taken, all this should be eliminated. This we used to call it in our CA Inter as mutual owings, if you remember. Yes, that's what we used to call it. Here we can simply refer it to as intercompany transaction. So how do you do cancellation of this? You have to reduce one liability, you have to reduce one asset. Liability account debit to asset account you credit. That's all. Okay. If there is any cash in transit wala item, okay. Suppose parent has given the money to subsidiary company has not yet received this because it's still in highway. So even the cash in transit item should be recorded in consolidated financial statements. How where we will record cash in transit is simply added to cash and cash equivalent balance. I proved it to you with numbers in the regular class. I'll not go too much into that now. Simply if there is any cash in transit wala item, add that cash in transit to cash and cash equivalent wala balance and then prepare consolidated financial statements. Okay. Yeah, that is it. Maybe we'll run through this also and then maybe take up next question. Next is consolidated SPL. Till now we prepared consolidated balance sheet. Okay, if I have to again sum up consolidated balance sheet, it's very simple. All assets and liabilities of parent and subsidiary, you add 100%. All outside liabilities also add 100%. Do not forget to show goodwill or bargain purchase gain. Okay. Then in equity share capital, only parent ka will come. Okay. And then do not forget to show non-controlling interest. If there is any mutual owings or intercompany transaction, eliminate that. That's all. Okay. And if there is any unrealized profit on inventory, deduct that as well. If the stock is overvalued, no, you need to reduce that. Okay. So that is also something you need to keep in mind. Okay. Rest everything is ditto, just going on addition. That's all it is. Okay. Next is consolidated SPL or SPL wala pointers. Consolidated SPL is also very straightforward. Take parent ka income and expenses, take subsidiary ka income and expenses, go on adding line by line, one by one. If there is any intercompany transaction, like parent sold goods to subsidiary, for parent it is sales, for subsidiary it is purchase, both will be eliminated, okay? Or parent gave some service to subsidiary company and charged some money. So for parent it's an income, for subsidiary it's an expense. There is also intercompany transaction eliminated, okay? That is one. And also you have to consider, this and all will be there already accounted by the parent and subsidiary, so you just need to add them. But some extra consolidation adjustments also will come. Like, sir, if there is any unrealized profit on goods sold, you need to eliminate. If there is any unrealized profit, means the profit element is included in closing stock. So closing stock is unnecessarily shown more. So closing stock you need to reduce. So if you have to reduce closing stock, means in consolidated SPL, we show something called cost of sales. So there is a direct relationship. How do you get cost of sales? Cost of sale is nothing but opening stock plus purchases minus closing stock. So if closing stock reduces, means cost of sale will increase. There is an inverse relationship. I have to prove it to you with numbers. If you want, you can take some random numbers and prove it for yourself. If opening stock increases, means cost of sale increases. If closing stock increases, means cost of sale reduces. Between closing stock and cost of sale, there is an inverse, ulta relationship. Okay. So due to this unrealized profit, we have to eliminate unrealized profit. So closing stock value will reduce. So cost of sale will increase due to this. That is one adjustment, consolidation adjustment you need to consider. And if any PP is revalued or if there is any fair value adjustment, then you may get some additional depreciation for current year. You're preparing current year P&L only, consolidated SPL only. This you need to consider, because all these are consolidation adjustment which parent and subsidiary company in their separate financial statements, they were not considered. So hence in consolidated financial statement, you need to consider this. And there is any impairment loss, especially on impairment loss on goodwill if it is there, that also you need to consider. And if there is any unrealized profit on PP sold, etc., that also you need to consider. Okay, that's one thing you need to do. Okay, and I've already showed it to you people. Here P&L has two parts. Okay, one is your normal profit after tax and then it is your OCI. Okay, so this is your main P&L. Here P&L has two parts. One is your main P&L and then you will show your OCI item. P&L plus OCI, if you add, that put together will become TCI, as in total comprehensive income. P&L plus OCI items, if you add, then you will get total comprehensive income. So what is the requirement is, out of PAT, you prepare consolidated SPL. No, out of this profit after tax of consolidated SPL, you need to tell how much belongs to parent and how much belongs to NCI. Parent and NCI share separately you need to call. Similarly, out of this total comprehensive income, if let's say total comprehensive income is 1 lakh, out of this 1 lakh, how much belongs to parent, how much belongs to NCI, you need to call. Okay. All right. How do you get NCI share? Don't take PAT. Let's say PAT of consolidated SPL is 1 lakh. NCI share is 20%. So don't directly take 1 lakh into 20%. Why? Sir, this 1 lakh is consolidated SPL. Consolidated SPL means it has parent ka profit also, it has subsidiary ka profit also. NCI is a shareholder in subsidiary company. He will not get parent company ka share of consolidated SPL. Okay. So what you have to do here is in these cases. Okay. So first, to find out NCI share, first you will take profit of only subsidiary company, because NCI is a shareholder only in subsidiary company. So take profit of subsidiary company. But subsidiary company would have not considered certain consolidation adjustment, which you need to consider. Like if there is any impairment loss, reduce it. If there is any unrealized profit made by subsidiary company through goods sold or by assets sold, doesn't matter, reduce it. If there is any additional depreciation due to fair value adjustment, reduce it. If there is any reversal of depreciation, add back. So then you will get revised PAT of subsidiary company. This is the revised PAT of subsidiary company. Out of that revised profit, you have to multiply NCI share to get the NCI share of profit, like this. This is what you need to work out. All these are not much tested in exam, but good to know. Okay. So this is about consolidated SPL ka preparation. Okay. Excuse me. Maybe these 2 points I'll quickly discuss and then we'll go for a question. Parent purchases or sells additional shares. So parent already had 70% shares. Parent already had 70% shares. Now they purchased another 10% more. They already had 70%. They purchased 10% more. If that is the case, means what we have to do. Okay. All right. So now, sir, you think they already had control, right? They purchased additional 10% more. That means all this transaction, we say it's a transaction happening between equity participants. So if there is any gain loss arising on this transaction, any transaction between equity participants, if there is any gain loss, it will always be booked in other equity. Okay. So when you purchase the journal entry, what will happen? Now, if you are getting additional shares, means earlier you had 70% stake. So NCI had 30% stake. Now you purchase 10% more, means parent ka share is 80%. So NCI ka share has become 20. From 30 it has become 20. So NCI ka share has reduced. NCI show visualize. Where do you show NCI in consolidated balance sheet? On the liability side. So NCI obviously has a credit balance. But due to this transaction, NCI ka balance is reducing. So NCI you will debit. Okay. Let's say the worth of the investment is 100. But parent paid, they purchased this stake by paying 120 because it's not necessary to buy and sell it at market price. All these are negotiation. You could buy it at any price. So to buy this 10% stake, parent gave 130, but the worth is only 100. That means there is a difference of how much? Or in fact, no, one second. The parent gave, in fact, I've written profit scenario. Okay. It could be anything. It's all right. Or maybe let's stick to the same example. Worth is 100, but the parent paid 120. That means the parent company made a loss. Doesn't matter. Whether it's profit or loss, this profit or loss will be going off the other equity only. This other equity is a balancing figure. In my sample entry, I visualize profit. Okay. So if it's the other way around, let's say like the worth of the investment is 80, but parent paid, let's say, only 70. That means obviously parent has paid, means money is going out. So you will credit to bank account 70. That means parent made a gain of 10, which will be again passed on other equity. So it doesn't matter whether it is gain or loss, that will be transferred off to other equity only. Okay. Then this is a purchase transaction. What if it is a sale? So whenever there is a sale, check if the control is still there or control is lost. Like let's say you had 70%, you sold off, let's say 60%. You had 70% stake in subsidiary company. You sold off 60% means now you have only 10%. With 10% you have control or you lost control. So you need to check that. Okay. After you sell, check if control is still there. If you feel control you have lost, then you have to apply loss of control wala accounting, which is here. Okay. But however, control is still there. Meaning, let's say you had 70%, you sold only 10%. You had 70%, you sold only 10%. That means you have still how much? 60%. With 60%, do you still get control? Yes. Okay. So control is still there means then what do you have to do? Obviously, you need to check. Again, this 10% wala transaction is a transaction between parent and NCA. It's a transaction between equity participants, and any gain loss that you get on this is accounted in other equity. Okay. In my sample entry, I've assumed it as a gain, but it could be loss also. Like, what do you do now? When you sell, your stake is reducing, NCA ka share is increasing. NCA has credit balance. Now, due to the sale, their stake increased. That means you have to credit NCA. Let's say the worth of the investment is 100. Parent paid, let's say 150. Okay. So worth was only 100. Okay. But parent sold it for 150. That means parent made a gain. It doesn't matter whether it is a gain or loss. That will be booked in other equity itself as a balancing figure. Okay. So that's about the additional shares or shares purchased or sold wala transaction. Okay. Maybe we'll do up this and this once, and then we'll take up two questions simultaneously. Easy to correlate. Okay. Then something called loss of control wala accounting. When will loss of control happen? In my example, I told, let's say parent had 70% stake before, they sold off, let's say 60%. 60% they sold. That means the remaining is only 10%. With 10%, will you get control? No, you lost control. Hence, what you have to do? There is something called loss of control accounting, which you need to apply. It's very simple, sir. When you got control, you think what and all parent did. In consolidated financial statement, when control was received, what did parent do? They recognized net assets of subsidiary company. They recognized goodwill, or they recognized bargain purchase gain, and they also recognized NCI, right? So when you had control, you recognized all this. When you lost control, what do you have to do? You have to cancel or de-recognize all of this. Okay. Net asset has debit balance. To de-recognize, what we have to do? Credit it. That's what I've written it over here. Goodwill has what balance? Debit balance. To de-recognize or cancel, what we have to do? Credit it. Okay. Then what's NCI has what balance? Credit balance. To cancel, what we have to do? Debit it. Okay. Then good bargain purchase gain or capitalism. It has what balance? Credit balance. To de-recognize, what we have to do? Debit it. Okay, sir. All right. If you have sold means obviously you would have received money. So bank account will be debited. All right. Now, investments generally don't come in consolidated financial statement. Instead of investment, net assets used to come. But now you have lost control. No? Here, entire investment did you sell? No, out of 70%, you sold only 60%. That means 10% is still remaining. So the fair value of remaining investment now you can show. Because you have lost control. No? So only investment you can show. So fair value of remaining investment will come. So the balancing figure is nothing but your gain or loss. If the balancing figure comes on the credit side, it's a gain. If it comes on the debit side, it's a case of a loss. Okay. This particular journal entry only we have represented as a statement format. Now you tell me what is how do you construct a statement for gain or loss? All this, whatever is coming on the debit side, you add. Whatever is coming on the credit side, you subtract. So what is the equation now? Take bank, the sale consideration basically, and add what? Add fair value of remaining investment. In a way, it's same like your goodwill calculation also. So sale consideration, which is nothing but your PC. Okay. I'm just giving you a context. That's all. Okay. So sale consideration plus fair value of remaining investment plus NCI. Okay. Then if you have any bargain purchase gain or capitalism, add it. Then deduct what? Net assets and deduct goodwill. Okay. So if you do this plus minus, right? If you do this plus minus, if you're getting a balancing figure, after plugging the numbers in the equation, if you're getting as a positive number, that means it's a gain. If you're getting as a negative number, it means it's a loss. Okay, that's all it is. If you don't want it in statement format, you can represent it in journal entry. Journal entry is more logical, okay, but statement format means probably a little easy. Okay, so whatever you're comfortable, you can do it. Okay, just to be retracing it, the statement is bank account, take bank, take sale consideration basically, fair value of remaining investment, add NCI. If there is any capital reserve, very rare scenario, add it. Less goodwill, and then excuse me, if there is any net assets, you have to reduce it. NCI we have already added. So do this plus minus, positive number gain, negative number loss. This gain or loss on loss of control will be transferred off to SPL account. Okay. So that is a funda. I think 1 minute. Let's do a thing. Anyway, we've learned loss of control. We'll take up one question on loss of control immediately. That is better, I think. 1 minute. I'll take you through that question. Yeah, this one, question number 98. So let's go through this particular question, people. 1 second. Continuously speaking, it's a little difficult. Yeah, the voice gets dried up sooner. Yeah, I have to keep sipping water in between. Excuse me, I have a little cold also, so that's causing a little more irritation in the throat. All right, so we just now saw loss of control wala accounting. So let's quickly apply it in this particular question. At the beginning of current financial year, AB Limited holds 90% equity shares in BC Limited. So AB Limited is the parent, the BC Limited is the subsidiary company. Okay, we have 90%. During the financial year, AB sells 70%. So in 90%, 70% they sold off. That means remaining is only 20%. With 20%, you don't get control. You only get significant influence. Yes, we have already studied this. So that means obviously this is a case of loss of control wala accounting. Okay. It sells 70% of equity interest in BC Limited to PQR for 56 crores. So this is your sale consideration. Maybe we'll plug in this number as it is. We already know this. Gain or loss, we need, whenever there is loss of control, we need to find out gain or loss. So sale consideration is 56 crores. Okay. Then we need, consequently loses control of BC, and at that date, fair value of 20% interest retained by AB Limited is 16 crore. We need fair value of remaining investment, which is given in the problem as 16 crore. Add fair value of remaining investment, which is 16 crores given. Then what? Net assets of BC Limited was fair value was 60 crore. Net assets we need to reduce. Have they reduced 60 crores? Yes. Net assets in the date of control 60 crores, reduce. Then what's anything else they told? Okay. Then they've given some reserves information, but they've not, I don't see any NCI information. If they don't give any NCI information, we'll assume NCI is valued on PSNA basis. So how much is net assets? 60 crore. Parent had how much before? They had 90%. If parent owns 90% means NCI initially would have had 10%. Yes, parent owns 90 means NCI will obviously have 10%. So obviously NCI will values on PSNA basis means 10% of net assets is NCI ka share. So 60 ka 10% is 6 crores. That is NCI ka share. Goodwill and capital reserve ka data they have not given, so I've kept it as 0. Plugging all this number, you're getting a positive number. So there is a gain. So we have done a loss of control on accounting and we've got a gain. And this gain will be transferred off to SPL account. Okay. This you need to pass it in journal entry format. If you want to pass, that's what they've asked. Okay. What is accounting treatment? You need to pass it in journal entry. What is the journal entry for this? Bank account debit. Here I think they've shown this. We'll show it to you over here. This is the debit and credit of journal entry, and this they're calling it as impact. Whether it will impact P&L or whether it will impact retained earnings. P&L means if it impacts means it will come in your SPL. When you prepare SPL account, okay, it will obviously affect that. Retained earnings means the effect will be shown. It affects P&L only, but the P&L effect will be given directly in balance sheet, not in SPL, statement of P&L. Okay, that is what they've called out in this particular statement. So what is the journal entry for this? Bank account debit, 56 crores. And fair value of remaining investment 16 crores. So bank account debit, where is that? Okay, here when they've shown it ulta. Here bank account debit 56 crores. This is the heading I think they've given. Okay, and then what's it? Investment account debit 16 crore. Then what? NCA account debit 6 crores. NCA has credit balance to cancel, we have debited. Okay, then what? Net assets we have to derecognize. Net assets has debit balance, to derecognize we have to credit to net assets account. What? 60 crore. Then what's it? A balancing figure. Balancing figure is coming on the credit side. So obviously it's a gain. So to gain on disposal of subsidiary, which is 18 crore, which will credit. This is arrived simply as a balancing figure in journal entry. Or you can write it as working note number 1 if you're prepared working note. Okay. So this gain or loss obviously will be affecting what? You'll directly give this gain, transfer it to retained earnings, or you'll show it in P&L. You'll directly show it in P&L. So it affects your P&L. That's what they have given. Okay, sir. Alright, this is one. Then they've given various other data. Sir, I already told you. Parent, no sir, when you're preparing consolidated financial statement, we just don't recognize P&L or post-acquisition profit of subsidiary company. If subsidiary company has any OCI items, other comprehensive income, doesn't matter whether it's a recyclable or reclassifiable OCI or NR, non-recyclable or non-reclassifiable OCI, doesn't matter. Or even OCI items we will recognize. Yes, NCI and the parent respective share. So they've given various OCI items. Debt investment classified through FV OCI. There are certain debt investments. Subsidiary company has some investments, okay, that they are valued under FVT OCI method. That means fair value gain loss, you will book it in OCI. So the debt ka investment value is 12 crore. This is anyway, this 12 crore is part of your net assets. That's already ED recognized. That's not a problem. But FVT OCI reserve is 6 crore rupees. If FVT OCI has a reserve of 6 crore, 90% of this will be belonging to parent and 10% will belonging to NCI. Correct? No? 90% of this will be what, sir? 5.4 crore and this will be 0.6. NCI we have already derecognized. Entire NCI we have derecognized. Correct? No? NCI ka share we have already given. We have already derecognized. So we don't have to worry about this. This parent share of 5.4 crores. No? Right? So there's an OCI item. But you have to check whether this is a recyclable OCI or non-recyclable. So if you are valuing debt under FVT OCI method, that is a recyclable OCI. So that means when this investment is sold or when you lose control, this OCI ka balance will be released directly into P&L. If it's a recyclable OCI, then the balance will be transferred off to P&L account. If it is non-recyclable OCIs, then the balance will be directly transferred off to retained earnings. So since this is recyclable OCI, this 5.4 crores ka parent balance will have to release from OCI to P&L account. So the journal entry you will pass is FVT OCI reserve account debit. It's a reserve. Reserve has credit balance. From that you have to transfer it to P&L. So reserve has credit balance, to transfer we have to debit. So FVT OCI reserve account debit, only parent ka share, which is 5.4 crore, to P&L account 5.4 crore. So this particular transaction affects, actually this should not come here, it should have come here. It's a typo. Okay, so this particular transaction affects P&L and not retained earnings. Similarly, we have other things also. Net defined benefit liability. We'll study more about this when we study employee benefits in days 19. Net defined benefit liability is 6 crores. Has resulted in reserve relating to net remeasurement loss. This we call it as actuarial loss. Sir, this is an OCI non-reclassifiable, non-recyclable OCIs. So how much is this? So 3 crore. So this is not profit. This is a loss. Loss means reserve. This particular reserve will have a debit balance. This you have to transfer it where? Since we have lost control over subsidiary and this is a non-recyclable OCI or non-reclassifiable OCI, directly you have to release it into retained earnings. But this OCI has a loss balance. That means it has debit balance. So to transfer, we need to credit. What will be debited? Retained earnings. So the journal entry will be retained earnings debit to net remeasurement loss. Only parent share, 3 crore ka 90%, which will be 2.7 crores. So this particular transaction does not affect P&L. This is P&L impact. Next is retained earnings impact. So this will impact only retained earnings. It will impact, how it will impact? Retained earnings balance will reduce like that. Next is equity investments. We know this. If you purchase any equity shares, means default category is FVTPL because CCF test will be failed. But there is also an irrevocable option. Check what has happened here. Equity investments not considered held for trading of 10 crore for which irrevocable option of recognizing fair value in OCI has been availed. Now in this equity financial assets, they are following FVT OCI method. Okay, and related FVT OCI reserve. When they say FVT OCI reserve, don't assume it's a loss. If it's a loss, clearly they will specify. Here they've sold FVT OCI reserve of 4 crore. That means this is a gain. The fair value gain, they've parked it in FVT OCI reserve. Now you have lost control. This is a subsidiary car. So you have lost control over subsidiary. So all this reserve correspondingly you need to transfer. So this is irrevocable option. That means this is a non-recyclable OCI. So this is OCI, OCI item has to be directly released into retained earnings. Entire amount, no, only parent ka share. NCI ka share already has been booked in NCI and NCI has been derecognized. So 4 crore ka 90% is 3.6 crore. FVT OCI reserve has credit balance. Now we have to transfer by debiting it. Credit will be given directly to retained earnings. So this affects only retained earnings. Okay. The last transaction that they have given here is what's a net assets of foreign operations, which is 20 crore, related FCTR, foreign currency translation reserve. So foreign currency translation reserve is also an OCI. This is a reclassifiable OCI. This is a reclassifiable OCI. So there's some FCTR balance of 8 crore. I already told you this, right? So as long as you have subsidiary company, FCTR will have a balance. Once you have lost control over subsidiary company, whatever FCTR balance you have directly, since it's a reclassifiable one, you'll directly transfer it off to P&L account. So total FCTR reserve is 8 crore. We don't want total, we want only parent share, which is 90%. 8 crore ka 90% is how much? 7.2 crores. So FCTR account debit to directly P&L account. So this impacts only P&L and not directly, not the retained earnings. So this is in a way good question. So they ask the gain or loss and loss of control as well as many OCI components. What will happen to such OCI components also got tested in this particular question. Okay, that way this question is pretty good. I think it has come 1 or 2 times also in exam, if I'm not mistaken. Okay, not that I'm saying this will come in your attempt. I'm just saying it has come. It might come also. Who knows? Yeah. What comes in exam, I don't know, people. Okay, I'm trying my best. I'm just using my best judgment and picking up few questions which I feel is a little more popular. Okay, may come, may not come. Absolutely no idea. If it comes, bumper for you. If it doesn't come, don't blame me, pa. Yeah, because I'm just using best judgment over here. Okay. All right. So this is your loss of control wala accounting which we saw. And then 1 second. We've seen this. This is over. This is over. Okay. Then we'll look at something called chain holding. Okay. First we'll go through this and then we'll take up one question on chain holding. Chain holding looks big. Okay. But trust me, it is not difficult. It's very straightforward question. Okay. But when you look at solution, it looks like 4 or 5 pages for a solution. So many people, by looking at solution only, they skip off. Okay. Actually, it is pretty straightforward question. So what is chain holding? Chain holding means, let's say parent has 80% control in subsidiary company S. S has another 70% in Z, meaning if subsidiary has another subsidiary. Okay. If your subsidiary has one more subsidiary, then such a scenario we call it as chain holding. Okay. So in chain holding, what do we need to do? Sir, in chain holding, finding out the shareholding percentage is very important. That we call it as effective shareholding percentage, meaning there's some calculations to be done. How to do it, I'll maybe tell you in one of the problems. Okay. Then there is something called indirect holding adjustment, or maybe here only we'll cover it off. I've taken a small example. P has 80% shares in S. So P is parent, S is subsidiary company. S has another 70% in Z, which they purchased it for 10 lakh. Okay. Now we have to calculate the shareholding percentage. This is pretty straightforward. Parent owns 80% means NCI owns 20%. That is not the case. So here we have one subsidiary or two subsidiaries. Two, when parent prepare consolidated financial statement, they need to take SCA data as well as ZCA data. Both needs to be taken and prepare consolidate, and CFS needs to be prepared. When P is consolidating with Z, no, you can't take 70%. You can't take 70% of shareholding percentage. Why? Sir, parent owns only 80% of S and S owns 70%. No, so you can't take like that. So here shareholding percentages, whatever S has done, no, 80% of that belongs to parent. Whatever S is there, whatever S is doing, be it assets or whatever, 80% of that belongs to parent. So S has purchased 70% in Z, means you take 80% of 70. 80% of 70 is how much? 56. So for consolidation purpose, you will take parent ka share is only 56%. How 56 again? 80% of 70. Okay. So 8 7 56. So parent ka share will be 56%. That means when you're consolidating Z, NCI ka parent has 56% means NCI ka share will be 44%. That is your first step, which is effective shareholding percentage. Okay. Then there is something called indirect holding adjustment. So you need to calculate this. So what is this? Sir, normally to find out goodwill and all, you take cost of investment. Cost of investment is what? S, when they purchased Z, they paid 10 lakh rupees. That's cost of investment. No, you can't take that. Why? Sir, S might have paid 10 lakh rupees. Entire 10 lakh came from P ka, because you're preparing CFS from P ka perspective. P is ultimate parent, right? From their perspective, you need to think. S, those spent 10 lakh rupees to get control of Z. Entire 10 lakh came from P. No. P has only 80% of S limited. That means you can't consider entire 10 lakh as cost of investment, but only 80% of it. So 10 lakh, 80% is how much? Only 8 lakh. Only 8 lakh you should consider as cost of investment for goodwill calculation of CFS. That means what is actual cost of investment? 10 lakh. How much you can consider? Only 8 lakh. The 2 lakh we call it as indirect holding adjustment. Our study material doesn't use these books. A lot of our foreign books like ACC and all, they bring in this term. Hence, because it's better to learn something with the term. A study material just directly puts this adjustment without calling what it is. Okay. But if you have a name, it's easy to remember by. So I've just used this name from the foreign books. There they call it as indirect holding adjustment. So indirect holding adjustment is what? Basically, out of 10 lakh, 80% money has come from parent, 20% has come from NCI. The NCI ka portion only we call it as indirect holding adjustment. NCI ka portion is how much? 20%. So 10 lakh or 20% is how much? 2 lakh. That is your indirect holding adjustment. Okay. This indirect holding adjustment, you have to reduce from cost of investment. That is one. And this money has come from NCI. No? That means NCI share is reduced. So when you're calculating NCI, no? NCI, this indirect holding adjustment has to be reduced from cost of investment as well as from NCI. Because money has gone out from NCI pocket means NCI share would have reduced. So hence IHI has to be reduced from both cost of investment and NCI. Rest every step is normal consolidation. Only this effective shareholding percentage and IHI. This is only extra fitting in chain holding. Okay, problem looks big because we are doing two company ka data we are consolidating, so obviously it will look big. But the only extra fitting here is this. If you calculate this properly, more or less you would say consolidation or chain holding wala question is done only. Okay, so let's maybe kind of confirm that with the help of question number 59. This is a chain holding wala question, so let's take that up. Just 1 second. Excuse me. Okay. Prepare consolidated balance sheet of as on 31st March 20x2 of a group companies comprising P Limited, S Limited and SS Limited. So 3 companies are there. Okay. 3 company ka balance sheet they've given. P Limited has purchased 32 lakh shares in S Limited. So P has purchased shares in S Limited. 24 lakh shares in SS Limited. S Limited has purchased. So S Limited has purchased some shares in SS. So P has control probably over S and S has probably control over SS Limited. So this scenario only we call it as chain holding, where subsidiary has another subsidiary. Sorry, how do you know subsidiary? They will tell ahead. That's the reason. Okay. So they have given the other data. Okay. Here reserves we have reserves and we have retained earnings also. Okay. So let's directly dive into the adjustment. P holds 80% in S Limited. Great. That means NCI owns 20%. S holds 75%. So P has control over S. S purchased 75% in SS. So subsidiary has another subsidiary and S has 75% control. That means NCI is 25%. No. You have to find out effective shareholding percentage. Their holdings were acquired on 30th September 20x. Okay, first can we find out effective shareholding percentage before we go further? So working on number 1 is that only, effective shareholding percentage. Here there are not 1 subsidiary company but 2 subsidiary company. First subsidiary company is pretty straightforward, S Limited. How much parent owns? Parent owns 80% in S directly. So parent ka share is, where is it? 80% and NCA ka share is 20%. So total becomes 100%. So this is very straightforward. Okay, when you do SS Limited, how much S has purchased in SS? 75%. Can you consider entire 75%? No. Whatever S owns, 80% of that belongs to parent. So you can't take entire 75%. So take 80% of 75. How much is 80% of 75? Which is 60%. So for consolidation purpose, you'll take parent ka share as only 60% over. That is 80% of 75, which is 60%. So non-controlling interest will have 40%. That gives you 40%. This is for consolidation perspective. Okay. All right. This is your working note number 1, effective shareholding percentage. Now let's read through the other things. The business activities of all the companies. Okay. Someone is saying, sir, you will share the chart book, sir. The chart book and all will not share. If you want to buy the chart book, it is available from our website, learn.arivupro.com or online.arivupro.com. You can go. We have 2 websites. Okay. We're trying to merge into one, but currently we have 2. Okay. So you can place the orders from that particular website. Both. If you want to buy the books, you can buy it from there. If you want to buy the classes also, you can buy it from there. Okay. All right. Now coming back to this particular question. The business activities of all companies are not seasonal in nature. Therefore, it can be assumed that the profits are earned evenly throughout the year. So every month ka profit indirectly they're saying is same. Now on 1st April 20x1, you acquired the control on 30th September people. That means 6 months has already passed. But they have given 1st April ka data. So this is your opening balance. The following balance stood in the books of S and SS Limited. Reserve and retained earnings. So reserve ka opening balance is given and reserve ka closing balance is also given. Okay, that means the reserve balance is also changing. Retained earnings balance is also changing. That means here you have to do some extra fitting for reserve also. Okay. So check here. Reserve ka opening balance was 80. This is of S Limited. And if you come to the S Limited ka balance sheet you prepare at the end of the year. Reserve of S Limited has become 100. From opening balance of 80, closing balance has become 100. So it has increased, right? So increase is made in the current year. So this used not to be there in the previous problem. In the previous problem, reserve ka opening balance and closing balance used to be same. Or at least we used to assume. Here we can't do that. So there's some extra fitting here for reserves. Same for retained earnings. Opening balance is 20. It has become 50. Same goes for SS. From opening balance to closing balance, there is some movement. There is some increase. Okay, we'll see what to do for this. And then 10. Maybe one more thing catching my eyes in the balance sheet is bills payable. If you just check bills payable, P Limited, S Limited is showing, and SS Limited, P Limited is showing. That means this is a bills payable among group companies. Okay, S Limited is showing S Limited is showing bills payable, sir, and this is bills payable to P. That means P will show this as a bill receivable. Bill receivable, bills payable transaction. This only we call it as intercompany transaction. All this can be shown in consolidated financial statements or eliminated. All this needs to be eliminated. Basically, this 30 and 70 put together is 100. 100 of bills payable should be eliminated. You have to eliminate it from bills payable also, eliminate it from bill receivable also. Intercompany transaction. That's the reason. They may have not tell this adjustment in additional information. Looking at balance sheet only, we are able to infer. Okay, if one company is showing it as bills payable, other company will obviously show it as bill receivable. So at both the places, you need to eliminate 100. Do not forget this. Okay, coming back to fourth adjustment, 10 lakh is included in the inventory figure of S Limited. Is inventory which has been purchased from SS. SS, the second subsidiary, has sold goods to first subsidiary, which is S. But they've not sold it at cost price. They've sold it at cost plus 25%. So second subsidiary company has made some profit. So some unrealized profit also needs to be eliminated. Okay, if you want, we can calculate this straight away. So sale has already happened, and this 10 lakh is included in inventory. So 10 lakh worth of this goods is included in inventory. So second subsidiary is already sold. That means this 10 lakh rupees is not the cost price, it is a selling price. Okay, now here, what is the profit? Profit is cost plus 25%. So if the cost is 100 rupees, means profit will be 25% of 100, which will be how much, sir? Profit will be 100 cut 25%, which will be 25 rupees. Means the selling price will be 125. Correct? No? So it's like this. Selling price, profit. If the selling price is 125, means profit is 25. Correct? Now this 10 lakh has already been sold by subsidiary SS Limited, which the S subsidiary is having in their books. That means this 10 lakh is a selling price. So if the selling price is 125, means profit is 25. If selling price is 10, means how much is it? So X is nothing but what? 10 lakh into 25 divided by 125. So which is nothing but 2 lakh. 2 lakh is basically your unrealized profit. This is your unrealized profit. Who made unrealized profit? Made by SS Limited. So if subsidiary company makes the profit, means you have to consider this in what? Analysis of profit wala, analysis of profits of subsidiary wala working note. That particular working note, you should not forget to consider 2 lakh rupees. But all the other numbers, above numbers, if you just check, all the above numbers were in lakhs. This is in full number. So don't eliminate 2 lakhs fully. Just take 2. Okay, because all the data is in lakhs. So that is one. Okay, next is what, sir? Anything else is given up? No, that's pretty much it. Okay, so now we need to calculate this. Okay, so one is the shareholding percentage, which we have done. There is no fair value adjustment, so that working note we can eliminate. So have you sold any PP? No, only inventory is sold, and unrealized profit we already calculated, so no working note. That means directly can we go for net assets? But hang on. We could have calculated net assets on the rate of control, but provided there was no drama around reserves. Here some reserve and all now is showing some increase in balance. So some portion of this reserve is pre-acquisition, some is post-acquisition. So let's get a little more clarity around reserves and surplus and retained earnings. So let's put up in this problem alone, because of adjustment, we are putting one extra working note called pre and post-acquisition reserves. Reserve here stands for reserve as well as retained earnings both. We are doing not one company ka consolidation, but two. So first take, what is the opening balance of reserve? Maybe I'll just eliminate this. The opening balance of reserve of S Limited is 80. Okay, so I'll take this. Excuse me. Okay, this is 80, which we have taken. So do you know the closing balance? Yeah, the closing balance of reserve of S Limited has become 100. It's there in your balance sheet. Okay, so I've taken it as 100 here. 1 second. I think it's taking a lot of time to load. It also needs a break, I think. Yeah. So opening balance is 80, closing balance is 100. That means from 80 it has become 100, means there is an increase during the year 20, and we got the control only on 1st October. That means of this increase, no sir, 6 months ka increase relates to pre-acquisition period. Do you agree with me? There's an increase for the whole year. We did not get the control on the first day. They only clearly told in the problem we got the control on 1st October. So April, May, June, July, August, September. 6 months has already passed. So out of this 20 lakhs increase, 6 months ka increase comes in the pre-acquisition period. It was already there when the control was, when the parent got the control. So 6 months of this is how much? 10. That is nothing but your pre-acquisition reserves. Okay. And opening balance of reserve was there before parent got the control. So this is also pre, this is also pre. So that means what is the total pre-acquisition reserve? 90. What is the closing balance of reserve? 100. In 100, if 90 is pre, means obviously post-acquisition reserve will be 10. Like that. So this was not there in the previous problem, hence we did not put this working note. This is there in this particular problem alone, hence we did this. Again, we'll tell you, do it for SS. If you have not understood, you will get some clarity now. SS Limited. What is opening balance of reserve of SS Limited that they've given? 60. What is the closing balance of reserve? 80. 60 has become 80. First, we'll note down this. Opening balance, 1 second. Opening balance is 60. Closing balance is 80. From 60, it became 80, means it has increased in the current year. And we got the control only after 6 months in the current year. So first 6 months has already passed. This 20 is for the whole year. It's meaning for 12 months. For 6 months, how much? For 6 months, the increase is 10. This was already there. That means this is pre-acquisition profit. Opening balance of reserve was there before parent got the control. So this is also pre. This is also pre. So total pre-acquisition reserve is how much? 70. The closing balance of reserve is 80. In 80, if 70 is pre means obviously the balance 10 will be post acquisition reserve. Okay. The same drama we have to do it for retained earnings also. Okay. Same things. Okay. Now come for retained earnings. Opening balance of retained earnings of S Limited was 20. Closing balance you'll get it from balance sheet, which is 50. Opening balance was 20. Closing balance is 50 as per the question. Okay, so that data will copy. Opening balance of retained earnings 20, closing is 50. So 20 has become 50 means it has increased in the current year by how much? 30. Okay, 30 is for the whole year, and we got the control only after 6 months. For first 6 months, how much? 30 is for the whole year. For first 6 months, how much is it? 15. This 15 was already there before parent company got the control. That means this is pre-part. Opening balance of retained earnings was already there before parent got control. That is also pre. So 20 plus 15 is how much? 35. 35 is pre. Total closing balance of retained earnings is 50. In 50 is 35 is pre means balance 15 will be post. Like that. So do the same calculation for SS Limited, you will get the pre and post. Because on the net, when you're calculating net assets, we want what, sir? We don't want total reserves. We want only pre-acquisition reserves, right? So here there was some drama around pre and post. That's the reason we put up this working note. Next, usually you put up net assets wala working note, but not for one company, but for two companies. So first, how do you find out net assets here? Shareholders funds approach. Look at the share capital of S. Where is that? Share capital of S Limited is 400. Okay, and SS Limited is 320. Have we copied that? We'll copy 400 and 320. We have copied. Then is what, sir? Pre-acquisition reserves is there already in our working note. What is the pre-acquisition reserve? 90 for here, 70 for this company. Have they taken? Yes. Only reserve is there? No. Retained earnings also there. So check. What is the pre-acquisition retained earnings? Pre-acquisition retained earnings is 35 for this company, 45 for the other company. Have they considered? Yes. So if you add all this, this was the reserve existing on the date of control. So share capital plus all the reserve existing on the date of control, which we refer to as pre-acquisition reserve. If you add it, you're going to get net assets on the date of control, which we have got it. Okay. Next is what? The usual working on goodwill. Not for one company, but for two companies. First, what you'll consider cost of investment. Who purchased this? Parent has purchased. So parent has only spent. What is the cost of investment? Check whatever data they've given. First, we'll copy. Investment value is 340 and 280. First, we'll copy this 340 and 280. Okay. So 340, there is no drama because parent only paid this. So there is nothing. But S Limited paid 280 to acquire shares in SS Limited. Entire 280 can you acquire? No. Whatever S Limited does, how much parent owns shares in S Limited? We already did this. Here only it is there. How much parent owns in S Limited? 80%. That means we should consider only 80% of investment. We can't consider full. Because entire 280 did not come from parent pocket. Only 80% came. Okay. The 20% came from whose pocket? NCI pocket. That 20% which came from NCI pocket only, we call it as indirect holding adjustment. So 280 ka 20% is 56, which is nothing but IHA. That's what we wrote here. No, IHA has to be reduced from cost of investment as well as from NCI working note. So we have reduced it from cost of investment here. Okay. So basically 280 ka 80% if you do, you're going to get 224. That's what we need to consider as cost of investment for CFS perspective. That is one. Then what, sir? If you have any fair value of existing investment, no. Then what? NCI you consider. What are they telling about NCI? Nothing they told. Or was it there in the next line? Okay, in fact, here it is there. Parent company has adopted an accounting policy to measure NCI at fair value. Okay, at quoted market price. Applying Ind AS 103. But we did not see any market price, no. Okay, check here. Assume market price of S Limited and SS Limited are same as their respective face value. They're saying face value and market value are same. Oh, okay. Alright. In the question, no, sir. Obviously, share capital you show it at face value. So 400 rupees, 400 lakhs is the total face value of the company. In this, NCI owns how much? 20%. So that they're saying face value and market value are same. So the market value of total investment is 400 lakh. NCI owns only 20%. So 400 ka 20% you do. How much is that? That's what I've written over here. Once again, 400 ka 20%, which is 80. The NCI of in S Limited is 80. What is the share capital of SS Limited, which is given in the balance sheet? 320. Okay. And when you, for consolidation purpose, how much are you considering? For SS Limited, when you're consolidating, NCI share, you're taking it as 40%. Yes, we have already written here. So share capital of SS Limited is 320. NCI share is 40%, which is 128. Problem specific adjustment. That's the reason we did. Okay. They only asked us to assume fair value and market value. Face value and market value are same. That's the reason we did this. Okay. Then deduct net assets on the rate of control, which you have called it above only. Deduct it. Then you're going to get, if it's positive number, goodwill, negative number, bargain purchase gain or capitalism. Here we're getting negative number. So it's a capitalism. Summing it up, it is 188. Both are capitalism scenario. Hence we summed up this. One, if you get goodwill, another capitalism, net it off, whichever is higher, show the higher number. If goodwill is higher, show it as goodwill. If capitalism is higher, show it as capitalism, like that. Okay. Next is analysis of profits of subsidiary company. Okay. Here also you need to worry because there is one adjustment. What? unrealized profit. Okay, unrealized profit has to be eliminated from retained earnings. But here, no, sir, we have what? Only one reserve? No, we have what? We have reserves also, we have retained earnings also. So you need to be a little careful over here. So come back to that working note. What is post-acquisition reserve of S Limited? 10. SS Limited, 10. So copy that first. Post-acquisition reserve of S Limited and SS Limited is 10, which we got it from previous working note. What do we do for post-acquisition reserve? This is not retained earnings, huh? This is a reserve. What do we do for post-acquisition reserve? Distribute among parent and NCA. In S Limited, parent ka share is 80%, NCA ka share is 20%. So 10 you distributed in 80-20 ratio, parent ka share is 8, NCA ka share is 2, like that. Okay. Same thing. In SS ka post-acquisition reserve, distribute among parent and NCA. Parent ka share is 60, NCA ka share is 40. So 10 into 60% is 6, 10 into 40% is 4. This is reserve wala drama. Okay. But we also have retained earnings. Do you know post-acquisition retained earnings? Yes, post-acquisition retained earnings, we have got it a previous working note, which is 15 and 5, which we have written. But straight away, don't distribute this. Why? So there is an unrealized profit made by SS Limited. And we already studied. If there is any unrealized profit, you have to reduce it from analysis of profits by a working note. And we have calculated that unrealized profit also on inventory. How much is that? Unrealized profit is 2 lakh. Okay, this you need to eliminate. Check, have they eliminated? Yes. Unrealized profit you need to eliminate. No need to prepare separate working note. You can simply show like this. 10 lakh is the selling price. Okay. If 125 is the selling price, means profit is 25. If 10 lakh is the selling price, means how much is the unrealized, how much is the profit? Like that we can calculate it. Okay. Or I had also given you an equation in our regular class. If profit is 25%, no, 25% is 1/4. If the profit is 1/4 on cost, it will always be 1/5 on selling price. That's what I've written initially there. Okay. If profit is 1/4 on cost, it will be 1/5 on selling price. Okay, like this. If profit is 1/5 on cost, it will be 1/6 on selling price. Like this. Go on adding 1 to the denominator. If profit is half on cost, it will be 1/3 on selling price. Like this also you can work out. Go on increasing the one number in the denominator, you will get the equation. If you don't want to do like this, that is also fine. Directly also you can do it. I've showed you both. Okay. Now eliminate this unrealized profit. What is the revised post-acquisition profit you're going to get? 15 and 13. That you need to distribute among parent and NCA. Parent ka share is 80, NCA ka share is 20. Distributed. Here it is 60-40. Distributed. That's all. Okay, you need to be careful in putting up the numbers. This will definitely look lengthy. It is time consuming also, but it is pretty straightforward. Only IHA and here some little drama around reserves. Otherwise, very, very straightforward question this is. Then it is non-controlling interest. Non-controlling interest also of 2 companies. So NCI on the date of control we already have. On the goodwill working note we have, I've copied it. Then what do you do? Don't directly add post-acquisition profit. You have to reduce IHA, no? Right? So NCI was a shareholder in S Limited. Yes, S Limited invested in SS Limited. So when S Limited invested in SS Limited, 20% of the investment came from NCI ka share. So that means NCI of S Limited you need to reduce. Be careful where you reduce. Don't reduce it from SS Limited. Okay. So S Limited invested in SS Limited. So when they invested, 20% of the money came from NCI ka pocket. So NCI of S Limited will get reduced. So IHA you have to reduce for 50. You have already reduced from cost of investment. Here you have to reduce it from S Limited ka NCI also. Okay. Then post-acquisition profit of NCI share you add. That we already got it over here. Post-acquisition profit share. NCI you have got it over here. No? Reserve share is 2. And what is that? Retained earnings ka share is 3. So 2 plus 3 is 5. That directly I've written it over here. Same for SS also. I've added and brought it up. If you want, you can show it separately also. Post-acquisition share of reserves separately. Post-acquisition share of retained earnings separately. Then you got the NCI. Clubbing it up, total NCI is 166.2, which will directly come in your consolidated balance sheet. Okay. Then the last working note is your other equity wala working note. It's not really a working note. It is actual note which you present to the financial statements. All the reserves you bring it in, that is the reserves, retained earnings, capital reserve and total. Okay. So now this, here you'll only consider parent ka reserve. So do you know the balance of reserves, sir? Only for holding company, which is ultimate parent, which is P. So what is the reserves? 180. So that they have not told whether this is 180 came in the current year or it was there as opening balance. I've assumed it as opening balance. You can also assume it as it came in the current year. Okay. Same go for retained earnings. They've given a retained earnings balance of 160. We don't know how much was opening, how much came during the year. Here opening balance, I'm assuming it as 0. Okay. Opening balance of retained earnings, I'm assuming it as 0. And I'm assuming that entire 160 came in the current year. You can make other assumption also. You can make this as 160 and make total comprehensive income as 0 also. Your choice because information not given. Okay. Then you did consolidation. Did you get any bargain purchase gain or capital reserve? Yes. You got a capital reserve. How much? Here 188. That only I've written it over here. Capital bargain purchase gain will be accumulated and shown as capital reserve and balance sheet. So add it. Okay. Then what? Post-acquisition profit. Parent ka share you need to bring in. Parent will get share from S also. You will get share from SS also, which we already worked out over here. Okay. He will get share of reserve also. He will get share of retained earnings also. Both are there over here. Check here. Post-acquisition reserve. reserve 80, of that parent share is how much? 8. So reserve balance will increase by 8. Similarly, post acquisition retained earning share of parent is how much? 12. So this is your retained earnings wala share. This from S Limited. Same thing you have to do it from SS Limited also. And finally, 561.8 is your total reserves, which will be shown in your consolidated balance sheet as other equity. If you just check consolidated balance sheet, they've shown other equity. I think they've clubbed all this. If you add all this, 194 plus 179.8 plus 188, if you do, you're getting 561.8. How much did our calculation show? Excuse me. It's loading. Yeah, 561.8. That's one. Okay, consolidated balance sheet is very straightforward. Okay, just two things you should not forget it. Additional is assets and liability to 100% addition. When you're doing inventory wala addition, there is inventory per here. Okay, maybe I'll show this. What is, one second, I'll get this a little closer, maybe a little easier. Okay, what was the inventory given in consolidated balance sheet? Now, three company ka data you need to add. 220 plus 70 plus 50. 220 plus 70, 290 plus 50 is 340. You can't show 340. There's some unrealized profit is included in inventory, which is how much? 2. So you need to reduce this. So inventory balance will become 338. Check, have they shown 338? Yes, they've done it in notes to accounts. All the three company assets you add. If there is any unrealized profit or mutual owings or intercompany transaction, you need to reduce. There is an unrealized profit in inventory, you need to reduce it there. Okay. This is not a problem. You need to be a little worried about bill receivable. Bill receivable, when you add 260 plus 100 plus 220 minus bills, you had some mutual owings. We already wrote it over here. 30 bills payable here, 70 bills payable here. Total mutual owings is 100. You need to reduce 100 from this. So 260 plus 100 is 360, 360, 380, 580, 580 or 480 will be your bill receivable, or 580. Yeah? What is that? 260 plus 100 plus 220 minus 100. Or okay, actually this trade receivables, I'm doing my bad. So trade receivables, you should not deduct 100. It should be done in bill receivable. No? So this is 580 only. What about bill receivable? 72 plus 30 you do minus 100 of intercompany transaction you do. So this is 102 minus 100, which will become 2. That's what they've done. Okay, that you don't forget. Rest of the assets go on adding line by line addition. Do not forget to show non-controlling interest. Capital reserve is already considered, so you don't have to worry about that. All the three company ka data you need to add over here. So that's all is your chain holding wala drama. Okay, looks lengthy, but once if you go through it, it's a very straightforward assignment if you ask me. Okay. All right. So I'll come back to the notes. What else was there? Excuse me. So chain holding is done. Loss of control is done. Next, what is there? So subsidiary consolidation with this we have done. Next we'll have to do it, but top 2. I told you we have 4 standards here. Ind AS 27, separate financial statement done. Subsidiary consolidation 110 done. Associate consolidation 28 and joint venture, which is 111. Those 2 are pending. If you run through that, this particular topic also dava. Alright, so associate consolidation, it's backed by Ind AS 28. Okay, sir, in subsidiary consolidation, what did you do? Parent took their own assets and added all subsidiary assets and liability. Okay, in associate consolidation, we will not do that. Parent will show their own assets and liability, but subsidiary assets and liabilities and all will not be shown. Assets and liabilities of associate company will not be shown in consolidation financial statement. First of all, if you want to go one step back, when will you do associate wala consolidation? You will do associate wala consolidation only if there is significant influence. Only if there is significant influence, consolidation for associate will arise. Otherwise, no. And when can you say significant influence arises? If the investor owns more than 20% or more voting power in another company. Okay. If more than 20% or more voting power is there, means by default we assume that significant influence exists. Okay. If there is significant influence, then we do consolidation through a specific method called equity method. We do consolidation under a method called equity method of consolidation. And how this equity method works is assets and liabilities of associate company, we don't show it in consolidated balance sheet. Only parent assets and liability will come. Associate will not come. Okay. However, investment made in associate will appear in consolidated balance sheet. Instead of showing assets, liability, NCI and all, no, we don't show all that. We only show straightforward investment in associate company. Whatever investment you have made, no, that will come in consolidated financial statement. But this investment, no, will be valued as per how the investment will be valued is as per the equity method. And what equity method says is simple. One trick, if you want to remember, means match investment ka balance with associate ka performance. Match investment ka balance with associate ka performance. Indirectly, Sir, if associate makes profit, investment in associate balance will increase. If associate makes profit, obviously if associate makes profit means associate company ka net asset will increase. We are a shareholder. No? We may not have control, but we still have significant influence. We are also shareholder. If where we have invested, let's say here P Limited has invested in A Limited. Okay, if let's say we have invested 30%. With 30%, we get significant influence. If associate company makes profit means this company A Limited ka net asset will increase. If their net asset increase, let's say their net asset increase by 100 rupees, we are also a shareholder in that company. No, that means of this 100 rupees increase, 30% increase is ours only. Yes, that means we'll also have a happy face. If associate makes the profit means investment value also will increase. If associate, however, makes a loss, investment value will reduce. If associate pays a dividend, if they pay dividend means cash balance will reduce. So obviously investment balance also will reduce like this. Okay. All right. Next, what, sir? If there is any fair value adjustment here, if there is any fair value adjustment, then take that fair value adjustment for calculation of goodwill. Sir, you'll show goodwill. No. Goodwill is calculated, but it is not shown. It's only for reporting purpose. Whenever you do associate consolidation, you will calculate goodwill same way. Okay, take the same way of calculation of goodwill, but this goodwill is not shown. Okay, it's not accounted. It's only disclosed. All right. However, if there is any additional depreciation due to fair value adjustment, that is reduced from associate share of profit. If associate makes profit, our investment balance will reduce. No, suppose associate makes profit of 10,000, but due to this fair value adjustment, we got an additional depreciation of 2,000. That means we will not increase the balance by 10,000. Associate share of profit will take it as only 8,000 like that. So associate additional depreciation due to fair value adjustment is reduced from associate share of profit like that. So additional depreciation will be considered, but fair value will not be considered because we are not showing. Additional depreciation basically affects associate ka profits. That's the reason we consider. Fair value adjustment affects associate ka assets. Assets are liabilities of associate company. We are not showing. That's the reason we ignore this. Okay, but goodwill here is only shown, but it is not it's only for the sake of disclosure purpose. It is not for the sake of accounting purpose. Okay. And I already told you, if associate makes profit, investment balance will increase. Investment has debit balance. To increase it again, what we will do? Again, debit it. Okay. Not only that, if associate makes any profit or any OCI, unrealized gain also if they make, that also will be there. So the journal entry you will pass is investment in associate account debit to share an associate profit, but that is basically SPL. To associate R, if associate has any OCI items, reclassifiable OCI item, that also our share, parent share or investor share we will record. If associate has any OCI non-recyclable item, so parent share of OCI also will record it. Okay, so this is the entry if associate has any profit or if they have any OCI items. It doesn't matter whether it is R or NR. Okay, if however associate makes loss, investment balance will reduce. So the journal entry will be SPL account debit to investment account. If associate anyway declares a dividend or if they pay the dividend, the investment balance will reduce. Okay, if they have declared the dividend means we have not yet received. So we will pass the journal entry dividend receivable account debit to investment account. If they already paid means bank account debit to investment account is a journal entry will pass. However, if there is any impairment loss on investment, they'll tell you all this in the problem. Then the journal entry will be impairment loss will be transferred to SPL. No, so you can write impairment loss account debit to investment, or directly you can write SPL account debit to investment account. Okay, this is one. Then next is significant influence lost. Sir, this is a pretty straightforward question. All these adjustments will be given in the problem. You may have to. They may ask you what's a past journal entry. So this itself is a good reference. If you revise the same thing, you'll have to replicate in exam and come and write. Okay. Maybe for 2 marks, I don't know, maybe for 2-3 marks, it may come also. Say, if significant influence is lost, what to be done? There we got loss of control accounting. Here, similarly, if you lose significant influence, like how will you lose significant influence? Let's say investor had 30% stake in one company. They sold off 25%. They had 30%, 25% they sold off. That means they have only how much now? 5%. Sir, if you want to get significant influence means the shareholding percentage should be 20% or more. Now, after selling, we have only 5%. With 5%, do we have significant influence? No, we lost it. So that's that scenario we're testing over here. So if significant influence is lost, obviously there will be some gain or loss. How do you compute that gain or loss? It is same like loss of control accounting. There, what did you do? Sale consideration, fair value of remaining investment, NCI, then capital reserve if it is there you added, net assets you deducted, goodwill you deducted, balancing figure was gain. If it was a positive number gain, negative number loss. Here also same thing, but few components will not come. Take sale consideration, add fair value of remaining investment if any. Here in associate consolidation, we don't show NCI, so ignore that part. Then what's there? There's no goodwill or capitalism. Ignore that. If we don't show net assets. Instead of net assets, what do we show? We show investment. So reduce the carrying amount of investment. That's all. So these 3 factors you consider: positive number gain, negative number loss. Basically, sale consideration, fair value of remaining investment, and reduce carrying value of carrying amount of investment in associate. Positive number gain, negative number loss on significant influence lost. Okay. One more thing you need to remember is, are we recording only associate share of profit? No, we are also recording associate share of OCI items. That OCI item could be R or NR. Whenever you lose control, we have already done. Whenever you lose control, OCI items, if it is R wala OCI items will be transferred off to SPA when you lose control. Here, when you lose significant influence. And NR wala OCI items will be transferred directly to retained earnings. That you need to remember. Okay. So if there is any loss, significant influence loss, then transfer OCI, reclassify OCI items, you transfer it off to SPL. Anyway, we would have recognized our own share. So whatever is the OCI that we have recognized, entirely release it into SPL. Okay. So, no, sir, should we release only 25%, sir? No, not like that. You had 30%. You sold off 25%. So 5% is still remaining. But with 5%, will you get significant influence? No. Sir, only when you have significant influence, you can record OCI, P&L, blah, 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 blah. Here, significant influence is lost, no? So the entire OCI item, not just 25%, okay? Not to the extent of sale. If you have lost significant influence, the total OCI R item should be released into SPL. And total OCI NR item will get released into retained earnings. Like that. Okay? Alright. This we already discussed. This, okay? Then unrealized profit also is the same drama, sir. If parent sold to investor company has sold to associate company, or associate has sold to investor, doesn't matter. If parent investor has sold, means it's a downstream wala, and here it's an upstream wala sale. Okay, the same drama. Now imagine parent has purchased, just 1 second. Parent has purchased some goods worth 100 rupees. Or maybe I'll write it bajo mein. Parent has purchased some goods whose costed 100 rupees. They have sold it to associate company for 120. Okay, what will happen? So in this transaction, parent made a profit of 20 rupees. Now visualize. Associate company, if they don't sell this goods, I mean they will show this goods as inventory. Since they purchased for 120, they will show it as 120. Okay. So in case of associate consolidation, associate company ka inventory and all will we show it in our balance sheet? No. Associate company assets and liability we will not show. That's not a problem. But the problem here is the worth of the inventory. So you are only preparing consolidated financial statement now, and you know, is the worth of the inventory really 120? Is the cost of the inventory really 120 or only 100? 100. But right now, associate company showing it at 120. Inventory is also an asset, sir. From 100, it should have been actually shown at 100, but it is shown at 120. I mean, because of this transaction, inventory value increased. If inventory of associate company increases, means net asset of associate company will increase, because to calculate net assets, we consider assets and liability only, no? So if inventory as an asset has increased due to this transaction, net asset also will increase. If net asset increase, means our investment will increase, because how are we valuing investment in this equity method? Based on associate ka performance. If associate ka net asset is increased, means our net asset also, or our investment balance also will increase. Okay, so that means this is unrealized, right? That we need to eliminate. That's what we're talking about it. Okay, entire subsidiary company ka net asset increase, do we record or only parent share? Parent will record only their share. Let's say here inventory as net asset is increased by 100 rupees, means entire 100 will investor company record? No, they'll record only their share. So hence in these sort of things, no, the unrealized profit is eliminated, not in full, but only parent share of unrealized profit will be eliminated. Okay, so here what is our total unrealized profit? 20. Let's say associate parent company has 30% share in associate. Parent has 30% share in associate. So entire 20 rupees will not be eliminated from unrealized profit. Only parent ka share. What is parent ka share? 20 ka 30%, which is 6. Only 6 will be eliminated from, will have to be eliminated. So what is the journal entry? If parent has made the sale, means it's a downstream sale. So that means the journal entry will be SPL account debit to investment account. Because anyway, which way we don't show the inventory. Because inventory is with associate. Associate ka inventory we don't show here in consolidation. Because associate ka assets and liability we never show. We only show our investment. So instead of SPL account debit to inventory, we write SPL account debit to investment. Like that. Because our investment value has increased by this transaction. Okay. Alright. Same thing if the other way around. Associate company has sold to the parent, means associate company made profit. Yes, if associate company makes the profit, means their net asset will increase. If associate company ka net asset increase, means parent ka investment again will increase. So it's the same journal entry, but you will pass only to the extent of parent share, because total net asset we will not record it over here. Only parent share of net assets we record. That's the reason only parent share of unrealized profit we have to eliminate it over here. Elimination entry is SPL account debit to, in my opinion, it should have been inventory, but our study material, as far as I have seen, they write SPL account debit to investment. Why can we use inventory here is, if associate has sold goods to parent, means parent only has that inventory, no? So you might as well reduce it from inventory. But our books, I think, says investment. I think for exams, you follow this only. It's better. Okay. Alright. So this is about associate wala consolidation ka topics. Done, sir? Okay. So there is one problem which is maybe a little important or newly added. So we'll quickly run through that question. So with this associate consolidation will get completed. Pay attention. This looks a little big, but again, pretty straightforward one. Sir, an entity has the three types of interest in associate. So we have not only purchased equity shares, we have three types of interest it seems. So what are those? Okay, first we have equity shares, 25% equity shares for which equity method of accounting is applied. Okay, we have some preference shares. So the investor company or the parent company, they have purchased some preference shares of associate company also. These are non-cumulative preference shares, part of net investment in associate. Okay, we have also given a loan to the associate company. Okay, the loan carries an interest rate of 10%. Interest income is received, and the loan is loan. They're saying it's accounted at amortized cost method. So ACM method is followed for this loan. They're saying blah 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 blah. So at the start of the year, the carrying amount they've given 10 lakh, 5 lakh, 3 lakhs. So this is the starting of the amount. Okay, so 1 minute. So opening balance of this careful. I just run through this. This is a straightforward question. So you just need to pay a little attention. So the opening balance. What is the opening balance? We have three things or three components associated with associate company. One is we purchased equity shares of associate company. We have some preference shares that we have invested in associate company, and we've also given a loan to associate company. Okay, so all are assets. Yes. So equity shares ka opening balance they told here. They've given opening balance 10 lakh, 5 lakh, 3 lakh. Equity ka 10, preference shares ka 5, long-term loan ka 3. Okay. All right. Now they've given. So obviously, sir, if it is preference shares and long-term loan and all means, obviously you have to account it as per Ind AS 109. So following table summarizes the changes in fair value of preference shares as per Ind AS 109 and impairment loss on long-term loan. So obviously these two has to be accounted as per Ind AS 109. Okay. Now for this only we follow equity method. We can't follow FVTOCA method over here. Don't apply Ind AS 109 to this one because you have significant influence. If you don't have significant influence, or if you're confused, what I'll tell you is like this. Sir, if you have more than 50%, then you have control. You have control and then you have to apply Ind AS 110. How to do the accounting? Ind AS 110 will tell. If you have 20% or more, or like if you have 20% up to, let's say, but if you have 20% but less than 50%, then you have significant influence and you have to apply Ind AS 28. How the investment should be valued? Ind AS 28 will give the guidance. At 50%, we say we have joint control. We may have to apply Ind AS 111 or Ind AS 28 depending on what it is. We'll see. If you have less than 20%, then it is your normal investment. Okay, this I'm talking about equity shares. Okay, if you have less than 20% equity shares in any company, it's a normal investment. Normal investment only we apply Ind AS 109. Okay, this is a normal investment, Ind AS 109. Anything more 20 or more, then you have to go with one of these four standards like this. Okay, fine. So this one you'll go for equity method because we have 25%. You have to apply Ind AS 28. For other two, you'll apply as per Ind AS 109. So obviously your value probably under fair value method. So they've given you fair value gain loss. Increase or decrease in fair value of preference shares as per Ind AS 109 for every year they've given. So preference shares in the first year has reduced by 50,000. This is a fair value loss. That means its balance will reduce. So before you do anything, first you give Ind AS 109 ka adjustment. It was 5 lakh. Its balance is fair value loss of 50,000 is there. So its balance is 4,50,000. This is for preference shares. Same thing for long-term loans. So there is an impairment loss. First year there is an impairment loss of 50,000 on this. So again its balance will reduce by 50,000 and it's become 2,50,000. Investment, however, there is nothing. So its balance is still 10 lakh only. Okay, sir. All right. Check this. Entity share in profit or loss of associate. This is not associate ka profit. They are talking about entity share in associate ka profit. So entity share only they have given. Okay, and it is what, sir? It is not profit. It is a loss. It is not total loss. This is 16 lakh is not the total loss of associate. It is parent's share of associate loss. It's parent share or investors ka share itself is 16 lakh. But if you just check, okay, our investment, equity investment ka value is only 10 lakh. We already know this. What does equity method says? Match associate ka investment balance with associate ka performance. If associate makes profit, investment value will increase. If associate makes loss, investment value will reduce. Here associate company reported a loss. They reported a lot more loss. Parent share of loss or investor share of loss is 16 lakh. But we have only 10 lakh in equity. Correct? No, in equity investment, we have only 10 lakh. So that means we can only reduce 10 lakh. What about other 6 lakh? Because our share of loss is not 16. It is not 10. It is 16. So 10 lakh, we reduce it from equity investment. Balance 6 lakh is there. No. You have other 2 interest also in associate company. Start reducing it from the other 2. First, you will set off the loss with investment in equity shares. Then with preference shares, and then against loan. This is the order. First, when you're setting off loss, first with always equity shares, then preference shares, and then your long-term loan or whatever. Okay. Then it is your loan. So 10 lakh you already adjusted with equity. Balance is how much? 6 lakh. Do you have 6 lakh in preference shares? No, you only have 4.5 lakh. So set off 4.5 lakh. How much loss still remains? 1.5 lakh. That 1.5 lakh you set it off with loan. That means equity investment in equity balance is 0. Investment in preference share balance is 0. Long-term loan ka balance has become 1 lakh rupees. This is long-term loan given. So it's an asset. So all these are financial assets only. Okay. So that means all this balance has become like this. Okay. This is first year ka closing balance, which becomes next year ka opening balance. So 0, 0, 1 lakh like this. Okay. Now see the second year drama. First you have to do Ind AS 109 ka adjustment because they are first accounted as per Ind AS 109. Then this loss adjustment will happen. Second year, there is again a fair value loss of preference shares 50, but nothing is there in loan. Okay. Sir, what is preference shares ka balance? 0. Opening balance. Because last year you fully wrote it off. Second year, again, there is a fair value loss of 50,000. Sir, you don't have any balance only. How can you adjust fair value loss? That means this balance has become negative. Correct? Okay. Now what you have to do is, boss, hang on. So priority is always Ind AS 109 ka adjustment first. So you have to set off this 50,000, but we don't have any balance at all. Hang on. Last year, how much loss did you set off from preference shares? 4.5 lakh now. That 50,000 you have to reverse now. Because you need to do fair value loss adjustment as per Ind AS 109. That is always priority. That means first what you will do, sir. This 50,000 associate share of loss you wrote off in last year, no? That you will reverse. So when you wrote off loss, you wrote minus 50,000. Here you write plus 50,000. Okay. So you have to create investment in preference shares to the extent of 50. Then book fair value loss of 50 so that its final balance will become 0. Like that. Okay, that means in reality, did preference shares take 4.5 lakh loss in second year? Though you took 4.5 lakh in year 1, 50,000 you reversed. Okay, fair enough. So that means this 50,000 loss, but you have not allocated. You have reversed from preference shares. Okay, like that. Okay, second year check, sir. What happened? Again, investor has a associate company made a loss, and investor share of loss is 2 lakh. 2 lakh loss is there. Do we have any balance? Yeah, one preference shares does not have any balance at all, so we cannot touch that. Loan has a balance of 1 lakh. Okay, that means how much loss can you allocate? 1 lakh. But in reality, in second year, you have allocated a loss of only 50,000. Why? So though you allocated 1 lakh loss, 50,000 loss you have reversed from preference shares. Okay, that means you have given a loss of only 150. The loss associate share of parent share of associate loss was 2 lakh, but you have allocated only 50. That means how much is unallocated? How much is unallocated? 1,50,000. Like this. Okay, fair enough. Maybe this once again I'll tell you. Okay, balance is this. First year ka closing will become second year ka opening. In second year, there is a fair value loss on preference shares. In Ind AS 109 ka, this is fair value loss. That is always the priority. You have to record this. But preference shares ka balance is already 0. So how can you adjust 50,000? Because its balance has become negative 50,000 now. No? Correct? So, but you have to adjust this. So hence, whatever loss you reversed in the last year against preference shares, how much loss did you set off? 450. How much you need for fair value loss adjustment now? 50 now. So the 50 loss you reverse. That 50 loss you reverse from preference shares. Okay, like that. So this 50 with this 50 you adjust. So you would have given fair value loss adjustment. That becomes 0. Like that. Okay. So in the second year also, associate company made a loss and parent share of loss is 2 lakh. Okay. So but long-term loan has a balance of only 1 lakh. So you adjusted only 1 lakh. And this 50,000 you did reversal also. That means though 2 lakh was a loss, you are able to adjust in the current year only 50,000. Right? Though you allocated 1 lakh loss against a long-term loan, 50,000 you reverse from preference shares. That means effectively you adjusted loss only to the extent of 50,000. So in 2 lakh you distributed loss only to the extent of 50,000. 150 is not yet distributed in year 2. Keep this in mind. So this is the closing balance. Closing balance will become second year ka closing will become third year ka opening. Again, third year check what happened. In third year, no, there is a fair value increase. Increase they are denoting as positive number. Decrease they are denoted as negative number. As per Ind AS 109, there is an increase both in preference shares as well as in loan balance. So obviously increase means what do you have to do in the third year? Where is third year? Here. There is a fair value increase. So this will increase by 1 lakh. This will increase by 50,000. So its balance will become 1 lakh and 50,000. Okay. But can you show this 150? No. In the last year, how much loss was unallocated? 1,50,000 associate share of loss you are still not allocated. Why? Because there was no balance. Now you got balance. Yes, allocate. How much balance is there in preference shares? 1 lakh. So allocate. Entire 1 lakh you allocate. How much? So that means of this 150, 1 lakh you give it to preference shares. Another 50,000 you have to give it against loan. So how much is the loan balance? 50. How much you will set off? 50. That means every component ka balance again has become negative. This is third year ka closing. Third year ka closing will become fourth year ka opening. So check in fourth year again what happened. In fourth year again there is a fair value increase of preference shares of 50. Here there is nothing. So here preference shares is increased by 50. So its revised balance here is equity shares is still 0. Preference shares is 50. Long term loan is still 0. What happened in the fourth year? Associate company made a loss or still? No. This year for a turnaround they made a profit. And this is not total profit. This is parent share of associate profit 10 lakh. Okay. Sir, when there is a loss, what is the order I said? First you will allocate the loss. Obviously, sir, it's common sense. Loss, who will bear the maximum loss? Equity instrument will bear maximum loss. Then preference shareholders. Then the loan guys, right? So now we are not talking about loss. We are talking about profit. Okay. Initially, when there is a loss, when equity shares balance was not sufficient, you give it off to preference shares and loan. Now when you get profit, don't transfer entire profit to equity shares ka investment. Loss is ulta. First, loss you allocated in this order, no? Profit you have to do it in ulta order. First, you will allocate the profit to loan, then to preference shares, and lastly to equity investments. Okay. So 10 lakh. So 10 lakh loan. How much loss totally preference shares is borne? Sir, preference shares ka balance, if you just check, initially it was 5 lakh. Now its balance has become 0. That means how much loss they have borne? 5 lakh rupees. That means 5 lakh ka profit you have to allocate to preference shares. So 50,000 was fair value increase, 5 lakh profit you assign, so it became 5 lakh 50,000. Now come back and check what was the initial balance of loans. Loan ka balance was 3 lakh. Now its balance has become 0, right? That means 3 lakh associate loss you have adjusted with long-term loan, which you need to reverse. So that means in the fourth year you will give 3 lakh against long-term loan. But as a total associate share of profit is 10 lakh. In 10 lakh, 3 lakh, 5 lakh you give it to preference shares, 3 lakh you adjusted against loan. How much still remains? 2 lakh. That you will give it to the equity shares. Hence the revised balance will become this much. Okay. Fourth year ka closing balance will become fifth year ka opening balance. Now all the loss has been set off also and it's been reversed also. That means now onwards if you get any profit, you will transfer only to equity shares. Because whatever loss you adjusted with preference shares and loan, that has been already restated. Now onwards, next fifth year, if associate company makes any profit, have they given? Yes, fifth year associate company again has made a profit and parent share or investor share of profit is 10 lakh. This 10 lakh will only give it to the investment, only to equity investment. Okay. Because all other things are already done. Fifth year, where is that? Fifth year, here. Again, fair value adjustment. So this 10 lakh, you will only give it to the associate. What about this? This is the fair value adjustment. I think there's some fair value adjustment in year 5 also. Preference shares is increased by 30,000. There is nothing here. So here is 30,000. So this is the revised balance. Associate share of profit of 10 lakh, you will only adjust it with equity shares because others have already been restated. So this is the balance. So this is a good question. Just watch it once. Very easy. Simple thing you need to keep in mind is the allocation of loss. Whenever there is a loss, right? Whenever associate company posts the loss, that investment balance will reduce, right? First try to reduce equity investment ka balance. Then if you have any preference shares, not any preference shares, it should be preference shares investment made in associate. First you reduce from equity. If that is not sufficient, reduce it from preference share investment made in associate. If that is also not sufficient, check if any investor has given some loan to associate company. Try to reduce that. Okay, like this. But do mind, before this loss adjustment, the priority is always first these two you have to do. Ind AS 109 ka fair value adjustment if there is any. First do that and then do this loss apportionment. Later on in the future years when you get profit, don't allocate the profit first to equity investment. Okay, you already loan guys and have taken a hit earlier years. No, first allocate to the profit of the loan. You restate the loan amount, then you restate the investment in preference shares and associate amount, and lastly you give it to equity shares like this. So that is what you need to keep in mind and accordingly do this table. Okay, so just watch out for this particular problem, an interesting one. Okay, excuse me. Then I think with this AS 28 ka Ind AS 28 ka consolidation we have fully done. 1 minute, let me reconfirm. Yeah, this we have done. Next is joint arrangement. The last component in this particular standard is joint arrangement. Joint arrangement is backed by Ind AS 111. Okay, sir, if you want to apply Ind AS 111, there has to be joint control. Only if there is joint control, then only you will apply Ind AS 111. Otherwise, no. Joint control means one person should not have control. Control should be diversified. It should be with 2 or more people. Okay, it's not necessary it should be with 2 people. 2 or more people should have the control. One person should not have control. So that's what we mean by joint control. We say joint control when there is collective control, meaning many people have control, and decision is unanimous. One entity or one person will not take the decision. Decision is taken by all. If all of them approve, you will do that decision. Otherwise, you will not do it. So only if that is there, then only you will apply. We say there is joint control and we apply Ind AS 111. Otherwise, we will not apply it. Okay, that is one. Okay, sir, Ind AS 111 says that there are 2 types of joint arrangement. Two types of this. Here we call it a joint arrangement, right? There are two types of joint arrangement which India's 111 says. One is in the nature of joint operation, another one in the nature of joint venture. JO and JV, joint operation as well as joint venture. If it is a joint operation, JO, right? Then, sir, normally some differentiating factor is there. Even this question also can come in your examination. Find out, they'll give you some case study and ask you to identify whether it is a JO or a JV. So some features I've listed it out. Based on this, you can categorize the joint arrangement either as a JO or a JV. Sir, in case of joint operation, there will be no new entity formed. New entity will not be formed. They'll just enter into a contractual agreement and each company will run their business in their own name. So new entity will not be formed for the joint arrangement. However, in case of JV, a new entity will be formed. Separate entity will be formed. That is one. That's one way to identify. Second one is in case of joint operations. Obviously there will be two or more parties. The parties in joint operations, the parties in joint operations will have a share in what? Joint operation ka assets, joint operation ka liability, joint operation ka income, joint operation ka expense. So in all joint operation ka asset, liability, income and expense, each party will have their own share and they will record their own share. So if the problem specifies that, okay, like even in case they tell like this, like just to give you an example, a new entity is formed, like this they will say, a new entity is formed. The moment you say new entity, that means you can't conclude it as joint venture. Hang on. If they say new entity is formed, but the parties in joint operation have entitlement in joint operation assets, liability, income and expense. If that is the case, even if no entity is formed, it will still be a JO. Okay, so in JO, parties will have a share over joint operation assets, liability, income and expense. However, in case of JV, right, the parties will not have share over assets and liability. Rather, they will have a share over net assets and net profits. They'll have net assets and net profits. All the assets, liability, income and expense is relating to JV. The parties in the contract only will have a share over net assets and net profits, like this. Okay, so you just check out for this. It's not necessary. New entity being formed is not mandatory. Okay, some cases it will be, some cases will not be. This will become more crucial factor in determining whether it is a JO or a JV. Okay, sir, if it is a JO, then we do proportionate consolidation method, meaning each person, let's say there is a joint operation where there are two parties, then whatever assets JO has, like let's say JO has a plant and machinery, let's say 10 lakh rupees. Okay, whatever assets joint operation has, let's say joint, there are two parties are A and B. A will record his portion. Let's say A and B has 50% share in this. That means A will record plant and machinery in his books to the extent of 50 lakh, that is 50%, and B will record 5 lakhs, rather not 50 lakhs. So A will record 5 lakh worth of plant and machinery in his books, B will record 5 lakh in his books. This we call it as proportionate consolidation method. So each party will record their own share of assets, liability, income and expense. That's what we mean by proportionate consolidation method. However, if it is a JV, then we follow equity method, and we already learned how equity method works. Okay, so that's the reason that to categorize, to find out whether it is a JO or a JV is important, because if it is a JO, you will do proportionate method. If it is a JV, we follow equity method. Again, how to find out? First thing is check this is all features. Okay, first one of the feature is in case of JO, no new entity will be formed. In case of JV, new entity will be formed. Second, in case of this is the most important factor. Okay, forget about entity, because in some case new entity will not be formed. So this one becomes a trumping factor. In case of JO, right, the parties in the contract will have a share in their assets, liability, income and expense of JO. But in case of JV, the parties in the contract will have a share in the net assets and net profit and not individual assets. Okay, like that. And yeah, that's the pointer, and we already discussed this. Yes. Okay. So I think we have a few questions relating to JO. Let's quickly run them by. I think 1 or 2 questions are there. That's all. 113. We'll quickly run through this. Another 10-15 minutes. That's all. We can wind up. Yeah. Just in case you are wondering. Yeah. CA Inter will do. Yes, CA Inter people, don't worry. We will do. Once I finish CA final marathon, Inter also will do. CA Foundation, I've stopped teaching so I am not be venturing into that. No time. So yeah. CA Inter guys, hang on. After this, we will do marathon. So don't come here and say CA Inter marathon and all that. Wait. Okay. We will do it. First, let me finish this. Okay. Question number 113. Let's go for. On 1st April 2017, Alpha Limited commenced a joint construction of property with Gamma Limited. So two parties are there. For this purpose, an agreement has been entered that provides for joint operation. I think they are only calling it as this is a JO. This joint arrangement is in the nature of JO. Okay. That means proportionate consolidation method and not equity method. And ownership of the property. Okay. All the ongoing expenditure comprising maintenance plus borrowing cost is shared equally. Okay. That means definitely GO. All the expenses they are sharing. No? Correct. So in case of JO only, all expense, all assets, income, liability will be shared. In case of JV, we don't do this. So definitely this is the JO only. The construction was completed on 30th September. So when did you start? 1st April. When did you complete? 30th September. So about 6 months you have taken for construction. And utilization of property started from 1st January. That is put to use. Put to use is irrelevant for us. We start depreciating. The moment asset is ready for use, we start depreciating. We should start depreciating from 1st October, not from 1st January. So that is just given to confuse us. We will not get confused at all. Okay. Useful life they've told is 20 years. So in the current year, so up to October, November, December, January, February, March. So for 6 months, we need to calculate the depreciation for the current year. Okay. All right. The total cost of construction of property was 40 crore. Besides internal accrual, the cost was partly funded by a loan of 10 crore rupees on 1st January. Loan carries an interest rate of 10%, which is payable at the end of the year on 31st December each year. The company has spent 4 lakh on maintenance of such property. Okay. The company has recorded the entire amount as investment in joint venture. They're just showing it as investment account. No. This is not investment account. This is wrong. Why? So this RTP question came in RTP November 2018. Sir, here it's a JO. It's not a JV. If it is a JV, then you follow equity method and you show investment. Yes, and investment will be recorded. Investment in joint venture will be recorded as per equity method. But this is a joint operation. That means you have to do proportionate consolidation. Your share of assets, your share of liability, your share of expense, your share of income, that you need to record, not the investment. Okay. So first, let's find out the property ka value here. Excuse me. Yes, it's applicable for CMA final also. Yeah. Okay. Yeah, classes are relevant. Okay. So you have constructed property worth 40 crore. So yeah, that can be added, right? But there is also borrowing cost. You took a loan. Sir, this you are constructing this property. So this is a qualifying asset. We already, we will be studying this. We have not yet studied. Okay. If you have taken any borrowing towards acquisition or construction or production of a qualifying asset, then the borrowing cost like interest, it will not be transferred to P&L. Rather, it will be capitalized. So have you taken a loan to construct this factory? Yes. How much loan? 10 crore. So 10 crore is a loan amount. And how much is the interest rate? 10%. Entire 1 year interest will you capitalize? No. What was your construction period? It started from April and ended on September. That means only for 6 months. So only 6 months interest you shall capitalize, which will be what? 50 lakhs? Or can I say 0.5 crores? Yeah. So 0.5 crores interest you shall capitalize. That means what is the value of this property, plant and equipment? It will become 40.5 crores. How many parties are there? Here, alpha and gamma. Alpha will record their share and gamma will record their share. What is their share? They've not told anything, I think. If they don't tell anything, we'll take it equally. I think they've told. It's to be shared equally, they told. So, okay, 40.5 divided by 2. What is that, sir? 20.25. Alpha will record as property, plant and equipment, 20.25 crore. And 20.25 crore. Gamma will record as PP in his books. Okay. So, what about other next period ka interest? Next 6 months ka interest will be transferred off to P&L account. So what about maintenance expenditure? Maintenance expenditure also will be going off to P&L account. Okay, like that. So this is the PPE to be recorded by the the parties in the joint venture. There is an expense also. So what is the expense? The borrowing cost. I'll write it as B cost. Borrowing cost transferred to SPL. How much is the borrowing cost? Total borrowing cost was 1 crore. In that 0.5 crore you capitalize means other 0.5 crores you have to transfer it to P&L. Not only this is there is some maintenance expenditure also. I think how much was the maintenance expenditure they told? Somewhere they told here 4 lakhs. Okay, I think this I'll represent in lakhs. It will be easier. 0.5 crore is nothing but 50 lakhs. So this is 50 lakhs, this is 4 lakhs. So the total expense is what, sir? The total expense is 54 lakhs. And it's a joint operation. So each party will record their share of expenses equally. So alpha, gamma. Alpha will record 50%. So 54 lakh, 50%, which is 27 lakh. Gamma will record 27 lakh of his expenditure. That's what they've given over here. Okay. Simple party. If there's a joint operation, each party will record their share of assets, their share of liability, their share of expense, their share of income. That's all is this particular question all about. Okay. You'll have to give JO ka probably 1 or 2 extra goalies. When it becomes JO, blah, 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 1 or 2 lines you write, and then accordingly write this conclusion. Good enough. Okay. All right. The next one is 115 and 116. Chain 2 question, small one, but quite important. Okay. Look at this. A Limited is one of the parties in joint operation holding 60%. So there is a joint operation. In this joint operation, there is A Limited and maybe then there is another party. We don't know other party. So in this joint operation, A has about 60%. Okay. In this joint operation, and balance 40% is held by another joint operator. Maybe we'll assume it as B. So B Limited has 40%. That means A Limited has control, no, sir? No. Yeah, actually, ideally, yes, more than 50% you get control. Maybe A Limited and B Limited have made an agreement saying all the decision has to be unanimous. Though A has 60%, let's say there is an agreement between A and B which says decision has to be taken both by A and B. Only if A and B both agree, then only you can go ahead and do that particular activity. Otherwise, no. So that means that agreement will have an overriding power. With 60% also, A will not be able to control this joint operation. Okay, maybe that agreement is there over here that they've not called. Okay, in these sort of question, don't question the question. Don't write in the answer there. A has 60%. That means A has control over it. So it is not Ind AS 111. You have to apply Ind AS 110 and all. Don't write that. Okay, there could be an agreement which should override this control aspect. Okay, so don't question the question in these cases. All right. Okay, next is what's up. A Limited has contributed an asset held by it to joint operation. So basically, A Limited, no sir, has sold an asset to the joint operation. One asset, maybe one property, plant and equipment or something. A Limited has sold to joint operation. Okay. The carrying value of the asset sold was 100 rupees, but asset was sold for 80 rupees. So A Limited is showing that asset in his books 100, but it was actually sold for only 80 rupees and at a loss of 20 rupees. So how should A record this in his books with a train? Okay. So it's a simple. A Limited has sold one asset to joint venture. Okay. What is the asset carrying amount? 100. You sold it for 80. That means the journal entry you will pass is what? Bank account debit. You got 80 rupees. They ask what's the journal entry A Limited should pass. So bank account debit to what account? To asset account. Whatever is asset. The carrying amount of the asset was 100. Then you will write loss account or SPL account debit 20. Correct? Normally you used to pass like this. But here you cannot pass like this. This, no sir, is not acceptable. Why? Sir, simple. Whom did you sell it to? A Limited sold the asset to joint operation. And A Limited has 60% share in joint operation. No? That means if you sell this asset to joint operation, 60% of joint operation belongs to you only. No? Correct? Though you are saying you sold it, correct? Whatever joint operation has, 60% of that belongs to you only. That means, is it really sale? Sale means what, sir? You should not have control over it. It's gone. Now you sold it to joint operation, and in that joint operation, if you own 60% means 60% of the asset belongs to you only. So hence you cannot record, this is for 100%, you cannot record it at 100%, right? Because what you have really sold is, earlier you had 100% control over the asset. Now you gave this asset to joint operation means so only 60% you have, only 60% of the asset belongs to you now. In fact, in reality, you have sold only 40%. So you can't record 80, you should record only 40%. So 80 ka 40% is how much? So you will pass the journal entry, bank account debit 32. What is 100 is the total carrying amount? What is 40%? 40 rupees. That means you will book a loss on sale only to the extent of 8 rupees or 8 lakh. That is the journal entry you need to pass. Understood? Or if you want it in one liner, only other parties share you record. Your party share purchase sale you don't record. Only other party share you record. Other party share is how much? 40%. Okay. Once again, if you want, I'll tell you this. A Limited has sold. A Limited you have sold means 100% you have to derecognize. You can't derecognize 100% because you sold it not to a third party but to a joint operation. And 60% of the joint operation belongs to you only. So that means 100% of the asset first you are selling, and you sold it to joint venture means 60% of the asset again will come back to you only. So essentially what you have sold? Only 40%. So only 40% of the amount you recorded as a sale. Only 40% you derecognize. And only 40% of the loss you book it. So don't book the entire amount. That's what is this particular entry. Not you don't book the entry to the extent of 100%, but only to the extent of 40%. Why 40%? Because the other party owns 40%. So essentially 40% of the asset you have sold to record that. That's all. Okay. This is in case of sale. Next is in case of purchase. Older. That's all. A Limited is one of the parties in joint operation holding 60%. B holds another 40%. Another joint operator. A Limited now has purchased. Instead of selling, now we have purchased. Okay, an asset from joint operation. Carrying value of the asset purchased is 100, but actually it was purchased only for 80 rupees. So we paid 80 rupees and we purchased. Okay. However, it is a loss. So at the time of, so you will book profit or loss only at the time of sale. At the time of purchase, what is the journal entry you will pass? If you buy an asset, the journal entry you will pass is PP account debit to bank. At the time of purchase, nobody passes any profit or loss. Only at the time of sale, we book profit or loss. So you need to pass a journal entry for asset purchase. What is the journal entry for PP purchase? PP account debit to bank account. So how much they said it's purchased for? 80. Can you record entire 80? No. Sir, whom did you purchase it from? You purchased it from joint operation. So A Limited, B Limited. You purchased it from JO. 60% of the JO was yours only. No? 60% of the asset was anyway yours. How can you purchase that? Because whatever JO has, 60% of the asset belongs to A Limited only. Now they are saying we purchased it from JO means 60% of that asset was anyway yours. What you have really purchased is other 40%. Because before, no, that asset was there under with whom? JO. If JO had any asset, 40% of the asset belongs to B Limited. Now you have purchased means this 40% now has come back to you. So it is not 100% purchase, because anyway 60% of the asset was yours only from the beginning. What you have really purchased is other party ka share, which is what? 40%. So you can't record. You purchased for 80, no? 80 is for 100%. For 40%, how much? 80 ka 40%, which is 32. So bank account or asset account debit to bank account 32. At the time of purchase, we don't book any profit or loss. So this is your quick accounting. Okay. All right. I'll just quickly sum up and see if there's any, if any question I've missed out. Just give me a minute. I think this and all we have solved. This is solved. This is solved. Yes, people. So with this consolidated financial statement revision also fully we have completed. Thank you for your patience. I know today was a little big topic, so we sat through for a long period of time. So thank you for that. Thank you for patiently sitting and watching through. So today I think we'll wind up for today. So tomorrow we'll catch up on the same time. We'll take up some more big important topics. We'll take it up in tomorrow's session. Thank you so much. Take care. See you. Bye bye.